Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello friends, welcome to the revision session of Business Valuation chapter. Now this is a fairly important chapter and it's also actually a very easy chapter. In fact, in most of the exams we have seen questions coming from this particular chapter. Once in 3 or 4 exams probably there is a miss, but 75% of the times you see some question or the other coming from this particular chapter. Okay, that is the first part. Second part that I want to tell all of you is this chapter is super easy. So ideally this chapter could have been kept immediately after security valuation. Okay, but then they've kept it towards the end, no problem. So if you finish security valuation equities and then come to this chapter, then also it is fine. And immediately after this, you should necessarily do the M&A chapter. Okay, now let us go ahead and look at this particular chapter. I will be covering both theoretical aspects as well as practical aspects. Brief theory, because these revision classes per se are both combination of theory, basic theory stuff and some formula related stuff, and then directly we'll go into problems and solutions, and there also we'll cover important problems. We'll not be talking every single problem. You guys should be aware of this book P600 plus. The PDF is also available to people who subscribe to our courses and all that. So you can go and have a look at the PDF there for solutions for all the problems, but I'll be covering some important problems in this. Okay. Now in this particular chapter there are only 4 or 5 varieties of problems that are actually asked in exam. Okay, one is this EVA, MBA related stuff. EVA is economic value added. Then you have a basic valuation of a business using FCFF or computation of CFA, and then valuation of the business using one of the models, either FCFF cash based or asset based or multiple based or a weighted average of those or something like that. That is second type of variety. Third type of variety is you also get problems on beta, asset beta, unlevered beta and all of that. And then you have certain variations of these in mixing of these and all of that stuff, right? Broadly only 3-4 varieties, nothing too much to worry about. You can very quickly finish this chapter if you understand the concept. So let us dive right into this. So let us dive right into these questions, and this PDF also obviously is uploaded as part of the revision lectures. You can go through them. Now first thing, again, I will not get into too much of depth, I will cover basic stuff. So first thing is, what is the need for valuation? Why do we need to value anything at all? See, when you value a company, you do it either because you want to acquire somebody or you yourself are a target for acquisition. You probably can use it for internal use also to see how much the value of the company is growing, what is the performance, how is the market valuing it, how am I compared to my peers, what is my size and all of that. I want to plan for a future listing, so I need to know what is the value today, how efficient the management has been, whether the management has been doing its job over the last 5 years, has the value of the company grown when the management is, new CEO has come in, has he made changes, are these changes reflective in improved value. For strategic planning, so I will become this size by 5 years, I will be 3x of my size, I will have so much market cap. Using that, probably I will do some future business. And it is also required for startups when you make investments into them. So these are broadly the needs for valuation. And when you look at approaches to valuation, how do you value an entity? You broadly have 4 approaches: asset based, income or earnings based, cash flow based, relative valuation and other approaches. 4 are main approaches and then there is other approaches. Now what is this asset based approach? In asset based approach, you have again 3 methods. Methods of valuation asset based approach is, you have net asset value method, that is you take all assets and minus all liabilities. Very, very simple. Everything is at book value. Very, very simple. Then you have net realizable value method, that is if you assume that you are going to liquidate or sell. First method, net asset value is book values, but realizable value is when you sell, how much will you get. So you basically will be marking all assets to market, that is investments, plant, whatever is recoverable, what is not recoverable, you will do all that activity. And then value at the sale price of all assets. Then you have a replacement cost, that is if I have to replace the existing assets, how much will it cost me. Right, these are the 3 methods in which you use asset based valuation. And please remember, net assets is equal to fixed asset plus current assets minus debt. So when you are doing value, you are valuing, when you are saying you are valuing an entity or anything like that, please always be very, very specific. Are you valuing the full business, which is called enterprise value, that is entity, enterprise, or are you valuing the equity shares, which is basically called as the market cap or value per share or things like that. So here when we talk about net assets, here we are talking about basically the equity value. Why are we saying equity value? Because we have already subtracted debt. So it is no longer the value of the entity or the enterprise, it is purely the value of the equity. And what are the limitations to this? Basically in case of asset based approach, right, it is dependent on historical and irrelevant inputs. Right. Ideally, all of us are used to, or we have, in all the previous chapters, we have learned that cash flows determine the value, right? Future cash flows, not even past. Presumptions of a lot of tangible assets. So for tangible assets, you have to make a lot of presumptions, and not suitable for intangible. That is, you can't value intangibles at book value and then take, right? Or if you want to sell it off, how will you value the intangible or goodwill or patent? Some of them may be valuable, but goodwill, how will you be able to value? So that is not possible. It doesn't consider future cash flows in operations. Obviously, that's what I was telling you. Doesn't consider future revenues, future operations and cash flow. Then it is least important for IT companies, where there are very few hard assets, but a lot more soft or IP assets. That is, where there is very few tangible assets. Net asset approach does not make any sense. It may make sense for somebody like Reliance or ONGC or Hindustan Zinc or somebody like that. It may not make sense for Infosys. Right. Now, this is the first thing. Then you come to second approach called income based approach. Income based approach is basically you do a PE or earnings yield multiplier, and in PE is the ratio at which all the companies trade with respect to their earnings. That is, if let's say Infosys today market price is 100 and EPS is 20, its PE is 100 by 20, which is 5. You already learned this both in, I think, at inter level and also in as far as the CFA and AFM is concerned. So PE is 5. Now Infosys is valued at 5 times its earnings, correct? Now should Wipro be valued at 5 times? Probably 4 times, probably 6 times. We don't know. If the Wipro has much better growth prospects, management is much better or something like that, whatever its earnings are, let's say its earnings are 10 rupees. So this 10 will be multiplied either by 5 if you think Infosys multiple is good, or you may multiply it by 6 or 7 or 3 or 4, whatever it is, depending on how, see, all the value you are ascribing, or rather all the working or all the judgment you are making is by ascribing a multiple. Okay, so that is a multiples based approach or a PE ratio based approach. Then you also have a earnings yield multiplier. What is earnings yield? Earnings yield is ulta. So what is PE ratio? PE is equal to price, whatever is in price, by earnings. What is earnings yield? Earnings yield is ulta of PE, that is 1 by PE, that is 1 by price by earnings, that is E by P. How much earnings are you getting on your price, or what is the yield? Let's say the EPS is 10 rupees and the market price is 100. So you are getting a return of 10%. The earnings return or earnings yield is 10% on the current market price. So that you can multiply. See, what you can do is, if you, let's say you have a EPS of 10, this 10, and let's assume the PE is 20. Okay, so this is EPS, this is PE. Let's say PE is 20. So what do you do? EPS into PE is 20, so your price is 200. Now here EPS you have projected. PE you are taking a PE ratio based on what you think is appropriate, comparing our company versus other companies and whatever industry average, better than average, lower than average, something you arrived at 20. So you will say the value of this particular share is 200. Okay. Other way to look at it is, EPS is 10. Instead of multiplying it by 20, I will divide it by the earnings yield. What is earnings yield? Earnings yield, let's say, is 5%. So 10 by 0.05, which will be what? Which will again be same 200. So what is 5% earnings yield? This is 1 by 20, that is 0.05. How did I get 1 by 20? Whatever is the PE ratio, 1 by PE ratio is basically the earnings yield. Okay, so that is how you use earnings yield. You use earnings yield to capitalize the earnings. So earnings yield multiplier. Either you use directly the PE ratio, in which case you multiply, or you divide by the earnings yield, which is 1, and where earnings yield is 1 by PE. Okay. Now you can also do by capitalization of earnings. What is capitalization of earnings? Just now what I told you. Whatever is maintainable profit. Now instead of looking at it at EPS perspective, you can say next few years I will maintain this much profit. On that profit you divide by the 1 by PE ratio. That is what basically is what capitalization of earnings. Then what are the limitations of this earnings based approach? In earnings based approach, PE ratio is followed. PE ratio equivalent for company, PE ratio of equivalent companies or industry for unlisted companies. See, what happens is, for listed companies you can say, for Infosys you can say Wipro or Cognizant or any of the other IT companies. But for unlisted companies, what will you do? Will you take the average of listed companies? Arey boss, but unlisted company and listed company may not trade at the same level. They may have different corporate governance rules. They may have different revenues. They may have different sizes. They may be in different business. So this becomes slightly difficult, slightly challenging when you are trying to use the multiples of a listed entity for trying to value an unlisted entity. So you may have to add a premium or have a discount also when you take a PE ratio. Then involves judgment, estimation of future expected profit. Obviously, there has to be a judgment. The entire business valuation is you are valuing based on your judgment. So that is one limitation which is there for all methods, if you honestly ask me. Then difference in treatment of extraordinary and exceptional items. This is something you have to be very, very careful about. What happens is a lot of places, these extraordinary items, companies do a lot of window dressing. They try and manage the earnings. So, if you don't figure out what is extraordinary, what is non-recurring, what is recurring, what is exceptional, what are the items that are one-off, and adjust for them and arrive at an adjusted profit or adjusted PAT or adjusted PBT or adjusted EBITDA. Anything that you do, you have to arrive at an adjusted number. Unless you do that, it becomes very, very difficult for you to arrive at a, make a proper case for valuing the company, or rather ensure that you value the company appropriately or accurately, because rest of the people in the market also do that. Right. Let's say you're an equity research analyst. When you are valuing a company, you have to take care of all adjustments and then project a future price. Same thing has to be done, will be done by other analysts also. So if you don't do it properly, others have a different target price, you may have a different target price, and you may be completely incorrect because some one-off items are unnecessarily influencing your future profit projections. Right. That is one. Then adjusted multiple give better results, which is what we were discussing now. Right. So these are the approaches with respect to asset-based and income-based. Now let us move to a cash flow-based approach. What is cash flow-based approach? You have two approaches. Even in cash flow, we normally know as what is known as free cash flow. Right. Free cash flows can be to either equity shareholder or to the entire entity. So FCFF, which is the firm, or FCFE, which is the equity shareholder. Now, what is the difference between these two? Difference between these two is largely with respect to what are all the cash flows that are eligible for the firm. That is, all the inflows, outflows, everything that are still with the firm without paying to any stakeholder. Who are the stakeholders? Your debt holders and preference holders and equity people. So what are the payments you make to all three of them? For debt, you pay interest and principal repayments. For preference, you pay preference dividends and preference redemptions or preference fresh money that you raise. For equity shareholders, you do, you pay dividends. Without making payments to any of these three financiers, what is the money that is available to the entity? So you basically are trying to separate the financing aspect of the cash flows from the operating aspect of the cash flow. So from operations, how much are you generating? So what is the formula for that? So we will first look at FCFF, which is basically from operations, and please don't equate it as cash flow from operations. No, cash flow from operations is actual cash flow from operations. Here we are saying free cash flow. Free meaning nothing needs to be paid to anybody else. So FCFF is a subsequent far lower down the order. That is to cash flow from operations, you will make some more adjustments to arrive at FCFF. So please don't mix both. And this FCFF is always after tax. Okay. So let us see. If you work from EBIT, so you will take EBIT into 1 minus tax rate. What is EBIT? EBIT is before making any interest payment, before any preference dividend, before any equity dividend, nothing, before any principal repayment, new loans taken, nothing, none of those are there. So that into 1 minus tax rate, plus you add back the depreciation. Why are you adding back the depreciation? Because depreciation is non-cat item. Minus you subtract the increase in working capital. Whatever is the increase in working capital, which you have to, which has to be met from your existing flows from the business, that you subtract. And you also subtract the capex. So basically, short-term and long-term asset needs are being met from the money that you are basically generating. And what is the money you are generating? EBIT into 1 minus tax rate plus depreciation. Same way, if you come to EBITDA, what is EBITDA? EBITDA difference is earnings before interest and tax. Other one is earnings before interest, tax and depreciation. Okay, so in EBIT, depreciation is already adjusted for, which is, and the tax impact on depreciation you are getting, which is why you are adding back full depreciation. Right. So let's say your EBITDA is 100, depreciation is 10. So what is your EBIT? EBIT is 90. Let's say tax rate is 20%. Okay. So 18. So what is net number? EBIT into 1 minus tax is 72 plus depreciation, because it's a non-cash item, you're adding back. So it is 10. So it is 82. Right. Now when you work from EBITDA level, right, What is this? This is FCFF. Assume for a moment that there is no working capital change, no capex. We are assume that those two numbers are 0. Then your FCFF is 82. Right. Now, if this FCFF is 82, if you work from EBITDA level, you can also do it as 100 into 1 minus 20%, which is basically your 80. Okay. This is what we did here. EBIT into 1 minus tax rate. Then you add the depreciation's tax impact. Why are we adding depreciation's tax impact? See, what is happening is, depreciation is not a cash flow, but because of the depreciation, you are getting a tax benefit. So, on depreciation, what is the depreciation number here? 10. 10 into 20%, which is 2. So, 82. Directly you get 82, right? You have subtracted tax, you have added back the tax impact of depreciation. So, you got 82 as the FCFF. Assuming, of course, increase in working capital is 0 or capex is 0. So, you got the same 82 number here. Right, again, please note we are looking at FCFF. Then you can work from PAT also. How do you do from PAT? PAT is after interest, after any preference payments, after anything, after all those stuff. So, what do? You take PAT, you add back depreciation. Why? Because depreciation tax impact has been considered, so you add back depreciation. Then you have this increase in working capital and capex that you keep aside. But you also have to add back the preference dividend. Why do you have to add back the preference dividend? Because preference dividend has been paid to preference shareholder. But when we are computing FCFF, it is the flows to the entire firm before making those payments. So, preference dividend has to be added back. Then interest expense, you will add back interest expense. Why? Because PAT is EBIT and EBITDA are before interest. PAT is after interest. So, you are adding back interest. But you add back interest after subtracting tax. Why? Because there is a tax benefit of interest. Okay. Then, of course, you also adjust any other dividends or interest incomes that you get. Well, here I am referring to incomes, not dividend appropriation or dividend payment to shareholders. No, I am referring to dividend income. The company may have some investment, something where it is getting dividend income. So, you see, the key word is all this is there. We are trying to arrive at operating cash flows, that is cash flows generated from business of the company that is attributable to all the stakeholders with equity, debt and preference, right. So, this is how you do. Now, fourth method, FCFF. So, if you come to this method, cash flow from operations, what is cash flow from operations as far as our Ind AS or AS are concerned? You take PAT and you add back the financing or investing activities, and then you also make subtractions for your working capital changes. Right, and you subtract also the dividend income and any other interest income that you got. So, you have to make adjustments for those. See, first you take CFO, from that you subtract capex, because CFO anyway does not have capex. When you compute CFO, you did not subtracted capex, now you are subtracting capex. So, what has initially happened when you computed PAT, you initially subtracted the entire interest expense. On that you took the tax benefit. So, basically your post-tax interest has been subtracted, correct? Now you have added back full interest. Why? See, if you look at PAT, let us say, EBIT is 100, let us say interest is 10. Okay. Then let us assume PBT, there is nothing else, PBT is 90, tax is 20%, which is 18. So, PAT is 72. Okay. Now, when you compute CFO, what is the PAT? PAT is 72. What did you do? You added back entire interest. In our all our workings for CFO as per Ind AS, we do that. Interest, because interest is a financing activity. So, interest you add back 10. But what has happened here, when this PAT has considered the tax benefit of interest expense. So, what is happening here, your CFO, let us assume there is no other item, your CFO is 80. If you now work backwards from PAT, how did we arrive based on PAT and assume there is no depreciation, anything, let us take purely EBIT and all of that. From PAT, you added back the interest expense into 1 minus tax rate. What is this? Interest expense is how much? Interest expense, PAT is 72 plus interest expense is how much? 10 into 1 minus tax rate of 20%, which is 8. So, you will basically get 80, right? 72 plus 8 is 80. Here, from CFO, if you have to do, what you should do to this 82, you should subtract tax benefit on interest, which is 20% on 10. Why? Because in CFO you have added, in PAT you have subtracted the post-tax interest, here you have added back full interest, so you have added back the tax benefit of interest extra. Here you have subtracted 1 minus tax into interest is what has gone out in PAT. In CFO you added back interest, so this is minus, this is plus, right. So, what has happened? interest will get cancelled, but what you have added back is the tax benefit of interest is being considered. Whereas when you looking at free cash flow to the firm, no tax benefit of interest also should come in, because it is all benefits for all stakeholders. So you subtract the tax benefit of interest, which is 2, you will get again 80 as your FCFF. That is why you subtract the interest expense ka tax benefit. Same way you add the tax benefit of dividend and interest income. Same logic, because when you compute CFO, you are subtracting the dividends and other interest income. Now you have to add them back for their tax benefit. Why? Because when you computed the PAT, you took them post tax. When you computed CFO, you added them pre-tax, so now you have to adjust for the tax impact only. Okay, so this is how you arrive at FCFF from CFO. Then what is FCFE? FCFE can be arrived from any of the 4 methods, but it is basically, or rather it is very simple if you remember it as FCFF minus or plus something is FCFE. What is minus and plus? See, all working capital is gone, capex is gone, all of that. What are the differences between FCFF and FCFE? Primarily any payments to your debt holders and preference holders, right? Equity holders, you cannot subtract or add. Why? Because you are computing for equity. So equity is balance left from the firm after making adjustments for your debt and preference shareholders. So FCFF, whatever you compute in any of the 4 methods, minus the preference dividend, minus preference shares repaid. Why are we subtracting minus preference shares repaid? Because I have generated some money from my business, from that I am making some payments to the preference fellows. So preference dividend as well as preference share repaid plus preference shares issued. Some money is coming into the company, that money whatever is coming into the company, that I will utilize for my, that will be in the control of the equity holders, right? Same way, debt raised, I add, debt repaid I subtract, and interest also I subtract into 1 minus t. So all this interest, everywhere here we have been adding back interest. Okay, because interest should not be considered. It is all the cash flows for including the interest. Here you are subtracting post-tax interest. Please note, everywhere we are considering post-tax items only. So when you think of CFAT, when we use the word CFAT, we use that word in multiple chapters. We use this word in advanced capital budgeting decisions. We use this word in security evaluation. We use this word in international financial management. We use this word in business valuation. We use this in multiple chapters. CFAT refers to your FC. If it is for the entire project, it is FCFF. If it is specifically for the equity shareholders, cash flows after taxes, FCFE. Okay, please do not forget this, right? Now, what is the limitations of this approach? See, WACC or discount rate based computation is tough. Okay, for let's say you have unlisted companies. How will you compute WACC? How will you compute discount rate? Now, discount rate is one single number in which you can put so many things, and finally, everything boils down to whether it is 15%, 14%, 12%, 13%, just negotiation, random numbers in the air. It makes it very, very subjective to one single number. Then which risk-free rate should be used? So when you use this FCF and FCF, how do you make the valuation? You first determine the free cash flows. You project the future cash flows, whether it is FCFF or FCFE. Then you ascertain the discount rate, which is what I was saying. It is a limitation. Discount rate is a limitation. Then you find a terminal value. What is the terminal value? Same Gordon growth formula what you use, D1 by KE minus G. So FCFE, I am taking FCFE or FCFF of the last year plus 1, that is the year after the last year, by, if it is FCFE, you do KE minus G. If it is FCFF, you do WACC minus G. That is how you arrive at the terminal value. Find terminal value, and then discount the FCFF and terminal value. So all the periodic cash flows you discount to present value. You have learned this in CA Inter, you have learned this in advanced capital budgeting, everywhere. You bring everything to the present value, and you also bring the FCFF terminal value or FCFE's terminal value to the present value, and then sum up all of them. Right. So discount rate is an issue. Risk-free rate. What risk-free rate should you use? Should you do it 5 years, 10 years, 15 years? Government bond. What government bond? And what is the tenure of the bond? Then what is the market return? How do you figure out what is the market return? I mean, I know that is for you as far as examination is concerned, they give 15% is market return, 12% is return. But in real life, what do you do? Do you take last 10 years average, last 15 years average? More cycles do you take? Do you take 100-year average? What do you do? Right. Then beta. After you compute the market return, beta is also again another variable. So you have a lot of variables, and then you put all of them together in terminal value computation. So you are basically condensing so many numbers into few numbers. So many cash flows are dependent on 3 or 4 numbers, and then that makes the whole valuation exercise super sensitive to these 4 or 5 variables. What are these variables? WACC or discount rate, your growth rates, your market risk premium, your risk-free rate, your beta. These determine the entire valuation that you do from especially when you do from a cash flow based valuation methodology. Now, expected return, that is expected return of a security, you can do it from capital asset pricing model. When you talk about expected return here, we are talking about the discount rate. How do you do that? You do it through ways. One is CAPM, one is arbitrage pricing theory. Arbitrage pricing, please don't forget, you studied in portfolio management chapter. What is capital asset pricing model? CAPM, RF plus beta into risk return the market minus RF. And in case of arbitrage pricing theory, you have multiple betas. That is, you have a beta for market, you have a beta for GDP, you have a beta for inflation. So for each one of them, you have a different beta, and for each one of them, you have a different risk premium. Right. So in case of CAPM, you do market cap is equal to FCFE by KE minus G. And from market cap, how do you arrive at EV? You arrive it as market cap plus debt minus cash. Please remember, this is a very, very important thing. A lot of students forget, sir, I should add cash or I should subtract cash. Should debt be added? Should I subtract debt? Please think very, very logically. An equity shareholder, what is the value attributable to them? It is total business minus whatever is payable to the debt. So, enterprise value minus debt. Okay, enterprise value minus debt. So, here I have put enterprise value is equal to market cap plus debt. That is, market cap is equal to enterprise value minus debt. You move this side, right? Then cash. Whatever cash is left with the company, that belongs to whom? That belongs to the equity shareholder. But is that generated? That is generated from business, but that is that particular number is basically not operating income, right? When you compute FCFF, are you taking operating incomes, or are you taking non-operating also? You are taking primarily operations. So when you compute EV is value of the business excluding cash. So EV is equal to market cap plus debt minus cash. And when you do the other way, what is market cap? Market cap is equal to EV minus debt plus cash. Okay, because the cash belongs to the equity shareholder. Okay, now this is one way when you do market cap basis. Other way is what you do from EV. What is EV? FCFF by WACC minus G. For market cap, it is FCFF by cost of equity minus G. For EV, it is FCFF by WACC minus G. And what exactly I told you, market cap is equal to EV minus debt plus cash. You subtract the debt, enterprise value is value of the entire entity. From that, you remove the value of the debt holder, you get the value of the equity shareholder. To this value, you are only valued the business. To the business, you have to value any surplus cash that is left, because that belongs to the equity shareholder. So you add that cash to the EV minus debt, you get the market cap. Of course, preference also has to be subtracted. That's a different thing. Okay, so this is how you do use the expected return for discount rate. Using that, you discount either the FCFE or FCFF and arrive at a value. Now, what is value? As per capitalization method, you take future maintainable profits, usually PAT, and divide by the capitalization rate. This is what I told you. You will get problems. This is one way in which problems are asked. External funds requirement. So this is also one question that is asked in exam. What is the external funds requirement? It is not being asked off late, but this was asked probably about 6-7 years ago. It is not being asked in the last few years. At least I have not seen this, but I thought I'd just let you know. It is basically money to be raised in debt and equity to meet increased asset size. Think of it. What is the fund requirement? Please don't confuse this with your fund flow statement, cash flow statement, all of that. External fund requirement is how much new money has to be raised from debt and equity to meet my existing requirements of what? Existing requirements of increasing assets. Then buyback. You also have buyback questions. This is one more kind of question that are there in this chapter. We'll be solving that. Buyback questions. Assume buyback price as something and then arrive at it. So you use simultaneous equations and do it. This is one more variety of questions. I just thought that I'll put the types of questions that are asked here so that when you're learning the basics itself, you'll get this particular thing. Right. Now moving forward, see, I will complete till here till this part of beta of assets. And then we will come to the questions. After we solve a few questions, then again we'll come back to the relevant theory aspects, and then we will subsequently move forward. Okay. Now in this particular chapter, some new topics have been added. These are very, very important. We'll come to that. Let us just finish this asset beta, and then we'll jump into problems. Okay. Now as far as beta is concerned, we have taken the beta here. Now this beta, is it beta of equity, or is it levered beta, unlevered beta? Typically, you have to take it as levered beta. That is adjusted for the debt level of this particular company. How do you find out levered, unlevered beta? What is asset beta? For that, you have to understand this whole thing. Beta of assets are basically unlevered, okay, or ungeared, okay, is beta of equity into equity by equity plus debt into 1 minus tax rate. Why are we doing debt into 1 minus tax rate? Because debt assume is a sum of future cash flows. On all the future cash, let's assume it's a perpetual debt, and then it is basically sum of present value of all the interest payments, and on all the interest payments you get a tax benefit. So that is why you're taking, not instead of equity and debt, you're taking equity plus debt into post-tax debt. Okay, debt into 1 minus tax rate, that is the weights, and beta of debt into d into 1 minus t by e plus d into 1 minus t. So basically you are weighting both by equity value and debt value, post-tax debt value, and arriving at beta of assets, right. So if beta debt is considered 0, that is typically debt does not have beta, then beta of equity, so you basically work this there. Is beta of equity is equal to 1 plus d by e into 1 minus t. Same thing, you are taking it on the other side. There is nothing beyond that. You are cross multiply and take it there. That is what you are doing. You are not doing anything else. Okay. Then this is this part. What are the other methods of valuation we said? Cash flow based, we discussed about beta and all that. Then you have relative valuation, other approaches. Let us look at relative valuation. Then we will go back to problems or go to problems. What is relative valuation? How do you do relative valuation? Relative valuation is you are comparing one particular firm with some metrics of a firm with another similar metrics of another firm, and you give the value of the firm you assign per that metric, and you apply the same value for other firms' metrics. What do I mean? We will understand. You identify drivers, identify comparable firms, analyze the competition, ignore outliers, determine the correct matrix to arrive at the EV. EV means enterprise value. Okay, you basically assume that markets are efficient and risk and reward of and growth of firms is comparable. Okay, now relative valuation may primarily you do PE and EBITDA. Okay, PE and EBITDA. PE ratio is most popular, which is equity based multiple. Then enterprise value based multiple is EV by EBITDA. You can also have things like EV by sales, EV by capital employed, all those also, but more often than not you use EV by EBITDA. Okay, PE ratio is most popular. So when I said metric, I am referring to a ratio. What are the ratios? Ratios are price to earnings, PEG, EV by EBITDA, EV by sales, EV by capital employed. These are the metrics. Now what is PEG? PEG we have not discussed, right? What is PEG? PEG is PE ratio divided by the growth rate. So if your growth rate is consistently, let's say 20%, 30%, then your PE can be higher. But if your PE is very, very high, then how do I compare your PE with somebody else's PE? You arrive at a PEG ratio. That is PE ratio I divided by the growth rate. So let's say if my PE is 20 and my growth rate is also 20, my PEG is 1. If somebody else has a PE of 20, but their growth rate is only 10, their PEG is 1, their PEG is 2. So we will say that other company is overvalued. Why? For a PE, if they are getting a PE of 20, even though their growth rate is only 10%, I am getting a PE of 20 when my growth rate is 20. So PEG typically should be close to 1. That is what people say. Now this is a rate that is used by this is a metric that is used by high growth companies. Now what is EV by EBITDA? Enterprise value, entire business ka value divided by EBITDA. You know what is EBITDA. EV by sales, what is this? I have entire business value by my sales, there is a ratio. Other company also I will see what is its EV, by its sales I will see a ratio. I am having a EV by sales ratio of 5, the other company has EV by sales ratio of 6. Why? Probably they are doing better, probably they have better margins, we don't know, right? So you go and try and figure out how the ratio stands out for different companies and then see what ratio should be applied for you. Right, then you have EV by capital employed. This is also one method where you use where there are capital intensive enterprises, you do entire EV divided by the capital employed. Whereas for early stage you use EV by sales. For other capital intensive business you use EV by EBITDA. Now for a bank, will EV by EBITDA work? No. Banks have a different way. Banks are usually valued by price to book. Okay, that's also one more method of relative valuation, price to book and ROE, right? So that is one more way, price to book. Okay, that is another way of relative valuation. Now, what are the other approaches? In addition to relative, we have also said there are other approaches to valuation. What is other approach? You now have this gross merchandise value. So, if you remember Flipkart, at the time of its particular sale, it was valued at some multiple of its gross merchandise value. That is, how much business is it doing? Basically, sales is what? Sales is your top line, but GMV is top line including the product sale what you have made. See what happens in sale. If I am a broker, what is my sale? My sale is not the value of the property that I sold. It is the commission that I made. That is my sale. Whereas in case of Flipkart, the actual revenue from operation should only be the commission that it is making. But what is the GMV? GMV means all the products that it has sold on its website, their value. Let's say their value is 1000, but the commission it earned is only 10 rupees. So Flipkart was valued up based on 1000, whereas if you look at its Ind AS financial statements, income of only 10 rupees will be shown. should you value it based on 10? Should you value it based on 1000? The buyer, Walmart, which acquired Flipkart, they chose to value it at 1000. So who are you and I to tell it is correct or not when the buyer chose a method to value? Right? Then you have average order value. So you have something called average order value. If you look at Zomato, Swiggy, which I've listed, their average order value, or even Zepto, which is planning for a listing, what is the average order size, how much are they valuing, how much are people ordering, all that come into consideration. So based on that, I have 1000 users. For each user, average order value is 10 rupees. So I have their, and each one orders 5 times a year. So that is their, and each customer will stay with me for 10 years. So that is their lifetime value. Based on that, I will apply some multiple. Right. Then you have price per pages visited. So if you look at some of these, companies, internet-based companies, where entire thing is about advertisement, or where they make money through advertisement, then price per number of pages, or people how many are visiting my website and all that. So at the height of boom, Unacademy raised money based on number of views of its YouTube channel. Okay, that is how they raise money. If the buyer of shares is willing to pay based on number of views on YouTube channel, you and I are nobody to say anything whether it is right or wrong. For in their view, it is right. Valuation is a art, not a science, right? Then price per subscriber. So you have telecom companies, Airtel, Idea is doing very poorly, but Airtel, Jio, all of this, price per subscriber. Number of subscribers you have, Airtel is valued at 10 rupees per subscriber, 100 rupees, 1000 rupees per subscriber. Is Jio valued at same? Maybe higher, maybe lower. We don't know. Daily average users on my app, Ghana, or any of these other things like Meta or your Snap, Twitter, X. So daily average user every day, million people are watching, or million people are using my app. So I will multiply each user by 100. So my value is 100 million. So things like that. That is another way in which you can value, right? So these are the broad ways in which you do value, right? So we have covered all these aspects, whatever we have discussed here, what are the various approaches. Now let us go and look at some problems, and then again after finishing that, we will come back to other aspects. There are some more other methods, exit multiple method, chop method. There are a bunch of other things, very interesting stuff that we'll come back to, and then we will look at it, right? We will also solve questions related to those, but before that, let us now go and look at questions with respect to all the concepts that we have learned so far. Otherwise, this is going to be a very boring exercise. Me explaining all theory first, then solving all problems later. It is not going to be making any sense. Okay, let us go and solve problems. Let us look at the first question. There is a privately held company, X Limited, that is operating in the retail space and is now scouting for angel investors. The details pertaining to valuing X Private Limited are as follows. The company has achieved break-even this year and has an EBITDA of 90. So this year, break-even and EBITDA of 90. Unleveraged beta based on industry in which it operates is 1.8 and average debt to equity is 4:6. The rate of return provided by risk-free liquid bonds is 5%. EV is to be taken a multiple of 5 on EBITDA. Accountant has informed that EBITDA of 90 includes an extraordinary gain of 10 for the year and a potential write-off of preliminary sales promotion costs of 20 are still pending. The internal assessment of rate of market return for the industry is 11%. FCFs for next 3 years are as follows: 100, 120, 150. They've just said FCFs, whether it is free cash flow to the firm, equity, we don't know. Pre-tax cost of debt is 12%, tax regime of 30%. What is the potential value to be placed on X Private Limited? Now, when you do this, X Private Limited, are they asking EV or are they asking shares of X Private Limited? They said value to be placed on the company. So, they are referring to EV. What is EBITDA? They have said first year EBITDA is this. Extraordinary gain includes an extraordinary gain of 10. So, you have to subtract that. So, minus 10. Then, and a potential write-off of preliminary sales promotion is still pending. Now, sales promotion cost, okay, it was initial number, okay, but it is still pending. So, now is sales promotion one time or is it recurring or so? See, ideally you should have written off at that particular point of time. If you have not written off, you should definitely write it off now. So, you have to necessarily write off. So, your net adjusted EBITDA is 60. From this adjusted EBITDA, what did they say? They say, what is the value? Now, do you do the value based on EV by EBITDA? Do you do the value based on cash flows or what? Because they have given both of them, you have to do by both methods. That is the understanding here. Okay, you've got this 60 of EBITDA, but then what? I mean, you directly multiply. Let us see. Your EBITDA multiple is 5, because they said here, no, EV is to be taken multiple of 5 on EBITDA. So value is 300. Now this is 300. If this is 300, then what is your unlevered beta? Unlevered beta is 1.8. From 1.8, you have to arrive back at the beta that is applicable for this company. How will you arrive at it? Beta of asset, which is 1.8, is equal to beta of equity into equity by equity plus 1 minus tax rate into debt. Okay, so you have to arrive at beta of equity. So 1.8 is equal to beta of equity, and what is the debt equity ratio? 40 is to 60. So 40 is debt, 60 is equity. So into 0.6 by 0.6 plus 1 minus 0.3 into 0.4. So 1.8 into by 0.6 is equal to beta of equity. What is this? 0.6 plus 1 minus 0.3. 1 minus 0.3 is 0.7. 0.7 into 4 is 0.28. 0.28 plus 0.6 is 0.88. So into 0.88 by 0.6. What does it come to? 1.8 into 0.88 by 0.6. 2.64. So you got the beta of 2.64. Right. From this, you have to arrive at cost of equity. What is cost of equity? Your cost of equity is risk-free rate plus MRP plus beta of equity. Risk-free rate is 5% already given. Market risk premium is 11 minus 5 into 2.64. You get cost of equity. And cost of debt, you also have to take 1 minus T. So you get 12 into 1 minus 30%. You get 8.4. Now here we have valued using EV. Okay, we got the value of the company. What did we do with all this stuff? All of this data is for us to arrive either at WACC, or is for us to either arrive at WACC or cost of equity. We already arrived at cost of equity. So why are we computing cost of debt? So that we can arrive at WACC. What is WACC? WACC is cost of debt into 1 minus T into D by D plus E plus cost of equity into E by D plus E. So you get 8.4 into 0.4 plus 20.84 into 0.6, you get 15.864. What do you do with this WACC? With this WACC, you discount the FCFF. What is FCFF? They have given the next 3 years ka cash flows. 100, 120, 150, correct? If you remember here, they have given 100, 120, 150. So you take these 3 cash flows, use the discount rate of 15% and arrive at the discount factor 0.86, 0.74, 0.64. You multiply those and you arrive at a value of 272.13. Now what is this 272.13? This is EV. Why is it EV? Because we have taken cash flows, we have taken WACC, so it is FCFF. If you FCFF, then it is EV. So in this case, EV is 272. In the other case, if you take a simple multiple, it is 300. So when they ask you questions like this, you have to say what is the potential value to be placed. The value could be either 272 or 300. So you have to write here. The value is in the range 272.13 to 300. It is lakhs or CR. What is it? They have not given the currency, that is brilliant. They have not given the currency, lakhs, crores or whatever it is. 272 to 30. This is how even in real life you value. You do one DCF, you do one EV by EBITDA, you do one PE, you do one net realizable value, then you do some other method, price to book. You collate all of them, you see all of them, you see where is it broadly, which one is more practical, applicable to the company, and then you use it. I have to take some weighted average. We will see some questions where we do some kind of average also. Then let us look at the next question. This is an interesting question. Using the chop shop method, nothing fancy, I will just take you through the method in 1 minute, you will be able to understand it. Very, very simple. Chop shop method, also known as sum of the parts method, is used to value conglomerates. What is it? Identify the industries to whom such business segments belong. So basically you have a company which is a conglomerate, you have different businesses. Each business you value by comparing with an industry to which it belongs. So calculate value for each business based on appropriate drivers of each industry. Let's say you have, an argument's sake, I am saying Aditya Birla Group. You are valuing one company called Aditya Birla. There is one holding company, assume, Aditya Birla Limited. That has Ultratech, which is a cement. That has Madura Coats, which is Madura Garments, which is fashion. So how do you value these two? For Ultratech, you take the multiple what is applicable for other cement companies. For fashion, you take multiple that is applicable to other fashion. So fashion may be priced to PE, but whereas cement may be valued on EV by EBITDA. So you take EV by EBITDA for cement business, you take PE for this business, combine both. Can they both be PE? They can. It depends on which one gives more appropriate or which is more logical way. Okay, and aggregate the value and discount the aggregate value to determine the chop shop value. So what is this discounting? Is discounting present value of cash flows? No, this is not present value of cash flows discounting. This discounting is When you have 2-3 businesses together in one single conglomerate or a holding company, there is a holding company discount or there is a discount for conglomerate. So independently Ultratech may be valued at 100 crores, but when it is, and independently your Madura Garments may be valued at 200 crores, but when, let's assume both of them are wholly owned divisions of Aditya Birla Group, Aditya Birla Limited, one imaginary company, this 100 plus this 200, 300 is not the value. You will say these two are fully owned by you. These both are conglomerate. There is nothing that, this is not listed anywhere. So there is a conglomerate discount and there probably is a holding company discount also. So that is the way you basically apply some discounts to those, right? So this is how you do basically your chop shop or some of the parts valuation. Then you have something called as exit multiples method. What is exit multiple methods? It is basically used to compute the terminal value in DCF valuation. So in DCF valuation, instead of doing KE minus G, whatever is the terminal period cash flow, you multiply it by multiple. What is that multiple that you use? You use a current P or EBITDA multiple, that whatever is there in the market today for similar kind of businesses. You apply the same multiple at that particular point of time and you get the terminal value. That terminal value is discounted to today. So this is basically exit multiples method. Okay. So these are basic two methods. Now let us get back to the problem what we are thinking of about the chop shop method. Let us read the question. Using the chop shop method or breakup value approach, assign a value for Cranberry Limited, whose stock is currently trading at a total market price of 4 million euros. This is not pounds, euros. At 4 million euros. For Cranberry Limited, the accounting data set forth in 3 business segments: consumer, retail, and general centers. Data for firms 3 segments are as follows. What is first? You have 3 segments: wholesale, retail, and general. Consumer, wholesale, retail, and general. Wholesale sales is 225,000, assets is 600,000, operating income is 75,000. So you have sales based method, you have assets based method, you have operating income based method. Let us see. I think there are 3 methods. Industry data for pure play firms have been compiled and summarized as follows. So this one firm has 3 businesses, but there are firms with only one business. There are firms with only wholesale business, firms only with retail, only with general. What are their capitalization to sales ratios? 0.85, 1.2, so on. Capitalization to assets, 1 ratio. Capitalization to operating income, another ratio. So each of the firm is valued under 3 methods: capitalization to sales, capitalization to assets, capitalization to operating income, right? This is the industry average. But as far as you are concerned, you have all 3 put together. So how do you value your firm? Let us see. Segment. So what are we asked to do? Assign a value. Assign a value. What is the value? We have not been given debt, and all. So we'll assume all of this is fully equity only. Enterprise value is equal to market cap, no cash, no debt, all of that. Right. So for all these 3 businesses, wholesale, retail, and general, what are the ratios for sales? 0.85, 1.2, and 0.8. What is your sales value? Your sales value they have given here: 225, 720, 2.5 million. So you put them and you arrive at values. Okay, these values, when you sum them up together, you get the value of this particular company. What is this company? Cranberry Limited. For Cranberry, when you look at capitalization to sales ratio, that is industry average, and apply the respective ratio to your sales and capitalize, you get a 3 million euros value. Same way you do for capitalization to assets. What are your assets? Multiply with the ratio, you get the value as per assets, which is 3.5 million. Then you have capitalization to operating income. So you have operating income ratio, whatever is the actual operating income, and you arrive at a value. So 3 million, 3.5 million, 4.65 million. So you see 3 million, 3.5 million, 4.6 million. Total average of these 3 is 3.78 million. So current market price is 4 million, average of these 3 is 3.7 million. So it is undervalued by 5%. So potentially it could go up by another 5%. So this is one way to look at it. Now they have said, they have not given any way where they said take a simple average. I have taken a simple average. That is how you are supposed to think on your feet in the exam also. Okay, this is a very simple question. I just wanted to show what is this chop shop. Don't unnecessarily get confused about something which is a very, very basic thing. Okay, let us move forward. Let us look at the next question. ABC is considering a new sales strategy that will be valid for next 4 years. They want to know the value of the new strategy. Following information relating to your to the year which has just ended. So this is past. Sales is 20,000 rupees. Gross margin is 20%, which is 4%, which is 4,000. Then SG&A is about 10%, which is 2,000. Then you have PBT of 2,000. Gross margin, which is 4. 4 minus 2 is another 2. From that you subtract 30% tax is 600. You get PAT of 1,400. What is balance sheet? Fixed asset, current assets, equity. Okay. So fixed asset plus current asset is 12, equity is 12, there is no debt. If it adopts new strategy, sales will grow at 20% per year for the 3 years. From 4th year onwards, cash flow will be stabilized. The gross margin ratio, asset turnover ratio, capital structure, income tax will remain unchanged. Depreciation will be 10% of NFA at the beginning of the year. The company's target rate of return is 5%. Remain incremental value. How do you compute incremental value? What is the current value? Do we know what is the current value? We do not know. Let us see. Okay, how do we solve this? First year 20,000. So these are the kind of questions where you are bound to make mistakes. Why? Because there is too much of computation. Multiply with calculate, even one mistake gone. So sales is going to grow at what rate? 20%. Okay, 20, 20, 20, and from fourth year it is constant. Please remember, they said very clearly from fourth year cash flow will be stabilized. So sales also is constant. Gross margin is 20%. So 20% of this, 20, 20, 20, and year 0. Please remember, you have to do the computation, but it is not used for projection. I mean, it is used for projection, but it is used as base for projection. But year 0 cash flows are not considered for valuing the company. Okay, they are considered for something else. What is that something else? We'll see. Right. Then you have admin expense 10%, then PBT, then tax. You subtract all of that, you get some PAT values. And PAT for year 3 and year 4 both are going to be the same. Okay, balance, what is going to happen? Fixed assets. This is where you should remember, or this is where you should apply your mind. What did they say? They said depreciation will be 10% of NFA. What is NFA here? Fixed asset turnover ratio. So here you are supposed to figure out my fixed assets, my turnover is 20,000 in year 0, whereas my fixed assets are how much? Fixed assets are 8,000. So the fixed asset turnover ratio, that is turnover in the numerator, fixed assets in the denominator, will remain constant. It's an assumption you have to make, so you have to state the assumption. Assume fixed asset turnover ratio will remain constant. You have to write this in the exam. So 2.5, 2.5, 2.5, 2.5. So based on that, you arrive at a fixed asset value. How did you arrive at fixed asset value? First year turnover is 20, 20 by 2.5 is 8. Next year, what is it? 24,000 by 2.5 is 9,600. Like that, for every year, you arrive at fixed assets value. From this fixed asset value, what do? You are supposed to compute the depreciation. So fixed asset opening is 8,000. From that, depreciation of 10% is 800. So 8,000 minus 800 is 7,200 and closing is 9,600. How did you get closing 9,600? Because we already computed. So the differential between those two is your additional capex. This is what you are supposed to figure out. This is the key trick in this particular question. So from this you arrive at additional capex. Like that you do for every year. But how will you do this? Will you do this for year 0? Year 0 not required. Only from 1 to 3, 4 you should do. And year 4, your capex and depreciation, both of them will match out. That is an assumption you have to make. Why? Because your closing value will be your opening value of net NFA. So which means what? Your depreciation and capex will keep matching out each other. Now after you do this is a part of the working note, then you come back. What about current assets? You look at current assets. Current assets are, where have they given? Current assets they have said 4,000. 4,000 is what percentage of your revenue of 20,000? It is 20%. So you take the same ratio, 20%, 20%, 20%, and you arrive at current assets numbers. You arrive at current assets numbers, and here also the last 2 years current asset numbers are going to remain the same. Right. So what is total asset? Your current asset plus fixed asset, you get the total asset. Your equity is equal to your total assets value. Why? Because there is no debt. Now, what is FCFF? FCFF is EBIT into 1 minus tax rate. Then you make changes. Okay. What is EBIT? Do we have EBIT here? No. We have PAT number. Why am I saying we have PAT? Because they directly have given here the PAT number. Okay. So PAT number. So from this PAT, what are the changes they have to make? PAT already, see, interest, there is no interest anyway. That is not out of the picture. You have capex. You have depreciation, then you have what else? Capex, depreciation, and working capital. These are the changes. So working capital is a reduction, very clear. Capex is a reduction, that is also very clear. Depreciation. What are you supposed to do with depreciation? Are you supposed to directly add back? Is there any tax impact on that? Let us go back and look at the thing what we saw. When you do from PAT basis, you directly are adding back depreciation. Why are you not computing any tax impact, tax benefit and all? The tax benefit comes only in EBITDA. For EBIT or PAT or CFO or everywhere else, in CFO of course anyway depreciation is not there. For EBIT based method and PAT based method, you directly add depreciation. Why? Because all the tax benefits have already been considered. Now you are adding back a non-cash item. Right. So you take the PAT, you subtract the increase in working capital. How is increase in working capital? Because whatever is the increase in net current assets is increase in working capital. You have to assume that current assets are net current assets. Then you have capex, which already computed. You have also add depreciations. You subtract capex, subtract working capital, and add depreciation. You get a free cash flow. Now, is this FCFF, FCFE? It is both same here because there is no debt value given. Now, if this is the FCFF, what is the FCFF for first year? FCFF for first year is, these are minus numbers. Please note, this is minus 1680 minus 800 minus 2400 plus 800 is minus 720 minus 864 minus 1034. So, for the first 3 years, the cash flows are negative. Fourth year only cash flow is positive. Why fourth year cash flow is positive? Because depreciation capex are matching each other. So, your fourth year cash flow is 2419. So, this 2419 is a fourth year cash flow. So, how do you value this cash flow 2419? They said capitalization rate something, no? Depreciation 10%, the company's target rate of return is 15%. So, you capitalize this terminal value also at 15%. You get a value of some 16,000. This you again discount. This 16,000 plus this minus 1,000, you get basically 15,000 number. That 15,000 you discount it for 3 years. Same way 720 you discount for 1 year, 860 you discount for 2 years, and this 15,000 you discount for 3 years. But when you discount, what rate will you use? Same 15%. So, when you add up all of these, you get 8643.31. This is the value of the firm, right? Now, what is a very specific question that they are asking? They are saying, what is the value added by new strategy? Value of the firm under new strategy is this. How will you arrive at the value of the strategy alone? That is, you will subtract the value of the firm under old strategy. What is value on the firm old strategy? Whatever is old FCFF, directly capitalize it by 15%. What is old FCFF? Old FCFF is for year 0. Year 0, whatever is the old FCFF. What is old FCFF? You have a PAT of 1400, right? Now, when the sales are not growing, when current assets are not growing, will there be additional capex? Yes, there will be maintenance capex that will match the depreciation. So, there is no increase in working capital, depreciation capex match. So, your PAT is your FCFF. This is what I wrote here. There are no changes in working capital, depreciation and current assets and capex. So, the PAT will be your FCFF. So, 1400 divided by 0.15. Okay. So, 1400 by 1.15 is 9,333. Old strategy is 9,300, new strategy is 8,600. So, the new strategy is value destructive by how much? 690. Incremental value of new strategy is minus 690. So, you should not, company should not go for new strategy as incremental value is negative. So, you are supposed to answer like this. Now, this question, I think it was an study material or some MTP question, one MTP question, older MTP question. But the reason why I took this is, nowadays the institute has become slightly more clearer in questions, but this particular kind of question explains you all the aspects that you should make assumptions on, what you should think, how to project future financial statements, all of that you can understand from this question, which is why I took, because you need to understand this. If any question that comes in exam which is a variant of this, you will be very easily able to understand. Okay, now let us move to the next question. This is again a question from study material. H Limited agrees to buy over the business of B Limited effective 1st April 2012. The summarized balance sheets of H Limited and B Limited as on 31st March 2012 are as follows. Balance sheet as of 31st March of 2012. Liabilities, in that liabilities you have equity shares of 100, equity shares of 10. One of them has 100 rupee shares, other one has 10 rupee shares face value. Reserve and surplus is given, total liabilities is there. Then you have net fixed asset, net current assets and deferred tax asset, total is also there. Okay. On the face itself, the H Limited is a bigger company, then B Limited is a smaller company. H Limited is acquiring the smaller company. H Limited proposes to buy out B Limited and the following information is provided to you as part of the scheme of buying. The weighted average post-tax maintainable profits of H and B Limited for the last 4 years are rupees 300 crores and 10 crores respectively. So, post-tax maintainable profits, what does it mean? You have to capitalize. Okay, we'll see what is the rate. Both companies envisage a capitalization rate of 8%. Very clear, super simple. H Limited has a contingent liability of 300 crores as on 31st March 2012. Oh, so this also is there. We have to figure this out. H Limited has to issue shares of 100 rupees each to the shareholders of B in terms of the exchange ratio arrived on the fair value basis. On fair value basis, you will arrive at an exchange ratio. How is that fair value error? We will see. Please consider weights of 1 and 3 for values of shares arrived at on net asset basis and earnings capitalization method basis respectively. So, you have to value the companies under two methods. One is earnings capitalization, other one is net assets, and you have to value under net asset basis and your earnings capitalization method and both the companies and give weightage of 1:3, 1 for net asset basis and 3 for capitalization method. and then you arrive at a fair value. How is it done? We have not done a question like this. I have been telling that you do an average of all of this. This is what this problem is based on that. You are required to arrive at the value of the shares of both H and B under NAV method, earnings capitalization method, and exchange ratio of shares of H to be issued to shareholders of B on fair value method, taking into assumption mentioned in point 4. What we discussed about that 1:3 ratio. Now, what is NAV method? NAV method is basically book value. NAV is book value of all assets less any adjustments that are required to be made. It is not net realizable value. Okay, book value plus any adjustment, plus or minus any adjustments. In this case, what is the adjustment? Only one adjustment, which is contingent liability. So you first take equity and reserves. See, you can either take from asset side or start from liability side. In liability side, or rather the sources of fund side, there is no debt. So the entire total of balance sheet on liability side is basically equity only, equity and reserves in surplus, right? Equity shares and reserves in surplus, so which is equity. So you take 1300 crores for H Limited and 31.5 crores, which is from here. Both of these numbers you take and you adjust for the contingent liability of 300 crores. So net you will arrive at a value of 1000 crores and 31.5 crores. So this is first method, which is NAV method. Super simple, straight. Only thing remember friends, whenever they give an NAV method and give any adjustment, you adjust for that particular adjustment that is to be made. Then equity share capital, what is the share capital? 350 crores and 6.5 crores. 350 crores and each share is 100 rupees. So you have 350 by 100, which is 3.5 crore shares. And you have 6.5 crores by 10, which is 65 lakh shares. Okay, that is what you put. So you NAV value, that is this 1000 crores of value, divide by the number of shares will give you per share. See, now one of the things that you can do is either arrive at the full value and then apply the weighting, that is 1:3 weighting, or arrive at per share value and then do the weighting. Either way, it doesn't make a difference. If you have not understood what I am saying, this 1000, keep this 1000 as 1000, keep this 31.5 as 31.5. And what did they say? Ratio 1:3. So this has a weight of 1, this has a weight of 1, and whatever is the earnings capitalization method, that has a weight of 3. So total company value basis, you can do 1:3 ratio, or you can find out per share value and do 1:3. Per share value, honestly, if you ask me, is more simpler because you have lesser digits to be multiplied, subtracted, divided, all. One time you do the division by, that 350 crores of share capital of 100 rupees each, which is 3.5 crores. So 1000 crores by 3.5 crores, you'll get one number, 285. So once you do that big division, then you need not do. I typically like this per share value basis. In exam, you'll get marks either way. Okay. Then earning capitalization method. What is earnings capitalization method? You basically take the maintainable, post-tax maintainable earnings for average for last 4 years, which is 300 crores and 10 crores, and divide by 8%. Why? You are capitalizing by 8%. So 300 by 8% and your 10 crores by 8%. So you get 3750 crores and 125 crores. Again, that you divide by 3.5 crores, this 125 divided by 65 lakhs, you get some 1000 rupees here and 192 rupees here. So you get 1000 rupees in one place and 192. Now what is the weight of this? Weight of this is 3, weight of this 285 is and 48 is 1. So you do that weighting. Fair value computation. NAV method is 285 and 48. Earnings capitalization is 1000, 71 and 192. You give a ratio of 1:3. So you get 285 into 1 plus 1071 into 3 by 4. So you get a value of 875 here and 156 here. If you have 875 and 156, what are all you required to find out? They very specifically said find out the value as per NAV, earnings capitalization and exchange ratio. So you have to find out exchange ratio. So what is the exchange ratio? How you compute? You compute 155:75. That is, for every 1 share of B, you get 0.1787 shares of H. It is apparent also, right? This H is valued at 875, B is valued at 156. So for every 1 share of B, you get lesser shares of H. Okay. Now, can you say the other way? That is, for you will give 1 share of H for how many shares of B? You can say that also. Okay. So it is basically inverse of this, 1 by 0.1787. That is, for every 5.596 shares of B, you will get 1 share of H. You can say that way also. But please, in exam, I typically do both of them. Just, we don't know what is there in answer as per examiner's key. So I do always, most of the times I suggest do both and give it. Okay. And one more point you have to note, contingent liability is recognized crystallized liability in NAV method, whereas it is assumed that the same is already factored in capitalization method and hence no effect has been given. So if you make any such assumptions, right, you have to state them. Now in this case, why have we adjusted this contingent liability only in the NAV method? Why not in the capitalization method? Because we assume that This particular contingent liability adjustment needs to be done only when you do NAV, not when you do pure earnings capitalization or anything like that. Okay, that is an underlying assumption. Can you make a different assumption? Yes. Okay, now we have looked at this. What is this? This is question number 8. Let us go and look at the next question. Again, see in this chapter, no, if you understand the flow, the questions are very simple. In fact, most of AFM that is the case. Only in 1 or 2 chapters where you have to think too much, like especially the forex chapter or derivatives chapter or portfolio management chapter, where there is a lot of you have to think aisa hoga, will it happen this way, will it that, which is this. You have to think of multiple alternatives. In most of the cases, right, especially these other chapters, business valuation, M&A, mutual funds, there's a simple flow. You have a format, you stick to the format, you constantly, go with that format, you'll get the solutions. See, so simple, right? Anyway, let us move to the next question. This is also again a question from study material. The valuation of Hansel Limited has been done by an investment analyst based on the expected free cash flow of rupees 54 lakhs for the following year and expected growth rate of 9%. So, expecting free cash flow. Now, is it FCFF or FCFE? We don't know. They just listen to this, that's all. The analyst has estimated the value of Hansel Limited to be 1800 lakhs. However, he committed a mistake. So, using this 54 lakhs and 9% growth, he estimated it at 1800 lakhs. However, he committed a mistake of using book values of debt and equity. Why do you use book values of debt and equity? For what? I don't know, for WACC or for what? Free cash flow, where will book values of debt and equity come? Only in WACC, in my opinion. The book weights employed by the analyst are not known, but you know that Hansel Limited has a cost of equity of 20% and post-tax cost of debt of 10%. See, WACC, that is where it is. The value of equity is thrice its book value, whereas the value of its debt is 9/10 of its book value. What is the correct value of Hansel Limited? This is again a question where you have to use some kind of equation. Now, ICAI likes these kind of equation based questions. I have seen in so many exams, especially we look at a problem from November 24 where buyback related question, and that kind of question, this is not first time they've asked multiple times. Same way if you see critical line theory in portfolio management, or you look at some mutual fund related questions, they seem to somehow like some kind of equation framing and substitution. I don't know what is that fetish that they have, or what is that love that they have for equation framing, but they genuinely love a lot of questions where equation framing is to be done. Okay, for equation framing, you have to understand the question. You have to understand the question, and you need not be phenomenal at maths. Your 10 standard, 11 standard maths is also sufficient for this. Okay, foundation maths is sufficient. Okay, now let us see how we solve this question. FCFF, we will assume it is FCFF. Why are we assuming FCFF? Because debt and equity both are given. If both are given, then what? Then if both are given, and what did they say? Value of Hansel Limited, value of the company. They are not giving value of equity. Okay, please note. So these are the subtle differences you should notice. So FCFF is 54 lakhs because FCFF is divided by WACC. When you have free cash flows, you divide them by WACC to arrive at the value of the enterprise, EV. Okay, G is 9%, value is 1800. So, as per Gordon growth model, FCFF by KE minus G. So, 1800 lakhs is equal to 54 by cost of capital. What is cost of capital? We don't know. We arrive at cost of capital by back working, we get it as 12%. How would I get 12%? 1800 is equal to 54 by something, and whatever is that something, from that you add 9, you get this 12%. So, you get 3 plus 9 is 12. Okay, very simple. So far simple, right? Then cost of equity they have given us 20%, cost of debt they have given us 10%, and cost of capital is 20. So equity debt in some ratio such that the weighted average cost of capital is 12. Right. So assuming weight of debt is to be x, the weight of equity to be x, then the weight of debt is obviously 1 minus x. So 12 is equal to 20 into x plus 10 into 1 minus x. So you solve for this, you get weight of equity is 20% and weight of debt as 80%. So what are the weights he has used? Do you know? We do not know. So when you solve for this x and 1 minus x, then you get the weights that he has used, and those what he has used are book values. The weights that he used, what we arrived as x and 1 minus x, are book value weights. So now we have to arrive at market value weights. What are market value weights? They themselves have said. The value of equity is thrice its book value. So equity is what? Currently we got 20% as equity. So actual equity is 3 times of that, actual equity is 60%. Then whereas market value of this debt is 9/10 of its book value. What did we get market value of debt as? We got 80% as debt. So 9/10, that is into 9 by 10, okay, 9 by 10 into 80 is 72, so 72%. So correct weight of equity and debt is not actually 60%, 72%, it is 60:72, it is 60:72. So you should do the revised cost of capital as 20% as the cost of equity into 60 by 132 plus cost of debt as 10 into 72 by 132. So then you will get 14.45%. This 14.45% is a weighted average cost of capital that you should use to discount the FCFF. So what is FCFF? We already know FCFF of 15. So 15 by 14% minus 9%. So you get a revised value of 973 crores. What is the original value that we got? 1800 crores. Why did the value come down? Because the discount rate has gone up. What was the old discount rate? Old discount rate was 12%. What is the new discount rate? New discount rate is 14%. So because of an increase in discount rate, the value of the company has come down. Hence, revised value of Hansel based on revised cost of capital is 973. In this question, only place where people will get doubt is, so if equity is 60, debt should be 1 minus 60, so it is 40. No. See, think of it this way, no? Weight as 20% and 80%. Assume that total capital is Y. In Y, we assumed 0.2 Y as equity and 0.8 Y as debt. Now, this total capital itself is wrong. This Y number is wrong. Why? Because this Y number you have considered on book value basis. So, now what you should do is arrive at correct values. So, you should multiply this 0.2, right, into 3 times its book value, whatever is equity ka book value, you will get the original market value of equity. Same way, 0.8, whatever is the debt value, you have to multiply it by 9/10 of it to get the market value of debt. Those two are the new weights that you should use for equity and debt. Those are not 60 is, if your equity is 60, debt is not 1 minus 60. Take it as 60% is its proportion and 72% is the proportion of debt. Please think of it that way. This is the only place where students have a potential to get confused. Please don't get confused. Okay, let's move to the next question. Following information is given in respect of WXY Limited, which is expected to grow at a rate of 20% per annum for next 3 years, after which growth rate will stabilize at 8% per annum in perpetuity. Revenue 7,500 crores, COGS is 3,000, your OPEX is 2,250, then CAPEX is 750 and depreciation included in OPEX is 600. During high growth period, revenue and EBIT will grow at 20% per annum. Capital expenditure net of depreciation will grow at 15%. From 4th year onwards, normal growth period, revenues and EBIT will grow at 8%. Incremental capex will be offset by depreciation. During both high and growth period, net working capital will be 25% of revenues. Okay, WACC is 15%, tax rate is 30%, estimated the value using FCFF and WACC. So FCFF means automatically WACC only. If it is FCFE, then it is cost of equity. Right, let us look at the solution for this. Present value interest factor they have given for 15% for year 1, 2 and 3. So it is fairly simple. That we need not bother about. Right. So revenue, first year is 7,500. This is year 0. From there it will grow at 20% per annum for next 3 years. 1, 2, 3. It has grown for 3 years and then it will stabilize at what? 8%. 8% is what they said, right? 8%. Same way, your COGS. COGS is also going to grow by 3,000 is going to grow by 20, 20, 20, then stabilize at 8%. Then OPEX. OPEX before depreciation. What is OPEX? 1650 is the OPEX. Total OPEX is what? Total OPEX is 2,250. From that you subtract depreciation of 600, you get 1650. So 1650 then growing at 20, 20, 20 and 8. So you get, then you have depreciation, some number. What is this number? How we arrived at it? We will see. Okay, what did they say for depreciation? CAPEX net of depreciation is 15%. So CAPEX and depreciation you have to compute separately, but please note EBIT is going to grow at 20%. See, if your revenue is going to grow at 20, all other expenses also have to grow at 20, only then your EBIT also will grow at 20. What is EBIT? Earnings before interest and tax, but after depreciation. So depreciation also has to go up at 20% only. Why is this important? Because this is important when you substitute it back in the table of CAPEX. Why? Because they said CAPEX net of depreciation is going to grow at 15%. So when depreciation number comes into the CAPEX table, then we'll see how it has to be handled. But EBIT is going to grow at 20%. Could we have done this directly at EBIT level? Yes, we could have, but then we will not know exact depreciation number. I mean, you'll have to again project only the depreciation number. Why? So I always think that project the full P&L or balance sheet wherever possible. Okay, extra 2-3 line items, but it will give you clarity. After finishing EBIT, let us come to CAPEX. CAPEX is actually, as I told you just a few minutes ago, is a balancing figure. So first you have to put depreciation. Whatever depreciation number you have put here, 600, 720, 864, please input it here. Okay, 600, 720, 864. Then CAPEX minus depreciation. What is CAPEX minus depreciation? CAPEX minus depreciation for the first year is capex is 750, depreciation is 600, so it is 150. So you put capex here as 750 and the net number is 150, capex minus depreciation. This number is going to grow by 15%. So 150 into 1.15 is 172.5. That is why this number is 172.5. Again, this 172.5 into 1.15 is what? 198.38. So this is capex minus depreciation. So your capex number is actually a summation of these two. So you add 720 plus 172. I'll just clean this up again. 720 plus 172, you get 892. Same way, 860 plus 198, you get 1062. Like that, you work backwards and arrive at capex. Why is capex required? Because in FCFF, you have to subtract capex. Please don't forget the formula. We will see. Then, net working capital as revenue. By percent, current assets as percentage of revenue. That's what they said, no? Net working capital requirement, 25% of revenue. So directly take whatever is the revenue number here, 7,500, 9,000, 10,800. You put that as working capital. Whatever is the difference 1 year to other year is increase in net working capital. Okay. So still here it is fairly simple. It is simple projection. Only place where you will get confused is your depreciation and capex schedule. What is FCFF? How do you compute? You first put EBIT into 1 minus tax rate. I genuinely always appreciate and like EBIT method only. Okay, it is simple. I don't like going backwards from PAT and all that. Most of the places where I've seen books also, people go by the EBIT approach, unless of course they specifically say use EBITDA based approach. Okay, what is EBIT based approach to FCFF? EBIT into 1 minus tax rate plus depreciation minus capex minus change in working capital. See, add depreciation minus capex minus change in working. Minus capex minus change in working capital. Here it is basically increase in working capital. So whatever is the increase we put here, and please note everything is from year 1. So capex and increase in working capital, here you have depreciation. And please note what they say here. From year 4 onwards, normal growth for revenues and EBIT will grow at 8%. Incremental capex will be offset by depreciation. So in the last year, capex and depreciation both are same. So you please see here, these two numbers are same. So here also these two numbers are same. Only for the previous years, you will have different capex and different depreciation. So what is the net number FCFF? Your 2,1100 into 1 minus tax rate plus depreciation minus capex minus change in working capital. So you arrive at these cash flows. Okay, these are the free cash flows after tax. These are FCFF. Okay, post tax FCFF. Now, what is VAT? 15%. They have already given the discount rate. So you take this discount rates. This is present value of explicit period. You multiply this, you will get this. Now, what is the value of the terminal value? Terminal value is whatever you have here, 2680 last year's cash flow divided by KE minus G. What is KE? 15% minus G. G is 8%. 8% is the perpetual growth rate, right? So 2680 by 15 minus 8, you get 38,000 something. So 38,000, you have to again bring it to present value by 3 years, because this is 4th year value brought to the end of 3rd year. So from 3rd year, you have to bring it to 0th year. So you will basically get 25,000. So 25,000 plus 3,000, you get 2,8850. That's it. Anything else you have to do? Estimate value using free cash flow and back. 28,000. That's all. Present value of this explicit period plus present value of the terminal value. See, it's a simple question, but here the trick is figuring out that depreciation capex are going to remain same last year, how working capital projection is to be done, then how terminal value is to be computed, then how to work backwards from depreciation to capital expenditure. So those are the critical issues here. And then of course that capital expenditure has to come in your FCFF computation. Okay, fair enough. Now let us move to the next question. This chapter has fairly simple questions, by the way. I mean, you don't think that I'm just moving through the lines. No, actually, even when you solve it also, it is fairly simple. It is not so complex. Okay, okay, let's move forward. So let us look at the next question, guys. This is from a Jan 21 question paper. Balance sheet of Mrs. Sundry Limited is as follows: share capital 300, reserves 200, long-term loans 400. Then short-term loan 300, payable and provision 200, total 1400. Fixed assets 600, inventory 500, receivables 240, cash 60, total 1400. Sales for the year was 600 lakhs. The sales are expected to grow by 20% during the year. Okay, the profit margin and dividend payout are expected to be 4% and 5% respectively. The company further desires during the current year sales to short-term loans and payables and provision should be in the ratio of 4:3. Ratio of fixed assets to long-term loan should be 1.5. Debt equity should not exceed 1.5. Okay, they have given a bunch of ratios. We will come to that when we look at the question in depth, or rather when we solve it. You are required to determine amount of external fund requirement. External fund requirement. If you remember, right side, what is the money that is to be raised from equity and debt afresh? Okay, whether it can be long-term, short-term, whatever it is. Then amount to be raised from short-term and long-term and equity. That basically they are asking a split of expected fund raise for external fund requirement. Okay, now sales is this, sales are expected to grow by 20. Company desires that current sales to short term and payable provision should be 4:3. We'll first take one ratio, then work on it. What is it? This is as on 2020 and they are asking us to do for next year. So 2020 is 600, next year is going to grow by 20%, which is 720. So far so good. Then profit margin is 4%. So 4% of this 720 is 28.8. So that is a profit margin. And dividend payout, they said is how much? 50%. So of 28.8, 50% is dividend. So balance 14.4 is retained. If 14.4 is retained, that goes and adds to your equity. Okay. Please remember that. We'll come back to that concept later. Then during the current year, sales to short term and payables should be in the ratio 4:3. Short term loans and payables. So what is short term loan here? 300. Payables is 200. Now payables and provisions both are there. Are payables and provisions both same? Yes, both together only. So this 500, okay, ratio should be, this is the 500 is last year's number. Currently this number should be how much? Should be in the ratio of 4:3. So if sales is 4, then short term loan and provision should be 3. Okay. Now sales is how much? 720. So how much should short term loan and provision be? Into 3/4. Correct? Into 3/4. If that is 4, this is 3. Right? So which is 540. So short term loan and provision. This is combination of both. Combination of this and this. Both put together. Right? Is 540. Now earlier how much was it? Earlier it was 500. It has increased to 540. Now how much has individually each of them increased? We don't know. We will see that. This is the trick in this entire question. Then fixed asset to long term loan. What is the other ratio they said? Ratio of fixed asset to long term loan should be 1.5. So what is fixed asset to long term loan? Fixed asset to long term loan is 1.5 and debt equity should not exceed 1.5. This is 100 pakka 1.5, but this can be below 1.5. Okay, if fixed assets is 600, fixed assets to long term loan. What is fixed asset here? Fixed asset here is 600. Now will 600 grow? Will it come down? Will it remain the same? We don't know. So what do? We say ki earlier fixed asset was 600 and turnover was 600, the ratio is 1. In the next year also the ratio will be maintained at 1. So 720 and 720 the ratio has to be same. So the fixed asset has to be your 1 time your revenue. So fixed asset has to be 720. Fixed asset is 720. What should be a long term loan? Fixed asset is 1.5 times of your long term loan. So 720 by 1.5, long term loan is 480. If long term loan is 480, then we have the second ratio. Debt equity ratio should be 1.5. It should be less than 1.5. Calculation of net working capital. We'll retain this 480 here and then come to working capital ratio. Why are we coming to working capital ratio number? So that we can arrive at provision numbers. So let us see. What is working capital number? Inventory earlier was 500. Okay. Now how much should it be? We will see. Receivable is 240. Cash is 60. Gross working capital is 800. 540 plus 240 plus 60 is 800 minus provision. Provision number they themselves have given as 200, payables and provision. So minus 200 will give you 600. So sales is 600, working capital is exactly 100% of sales. So if this is going to be the case, then next year also net working capital will be 100% of sales, that is 720 should be the net working capital. If this is going to be 720, then what are your inventory and other numbers? Let us see how much your inventory and other numbers will grow. If your sales is going to grow by 20%, then your inventory also should grow by 20%, your receivables also should grow by 20%, your cash should also grow by 20%, this becomes 960. If this is going to grow by 20%, then your provision also should grow by 20%. If you know what is the provision number, what can you arrive at? You already figured out that short-term loans plus payable both put together has to be 540. If you figured out your provision number is 240 and short-term loans plus provision is 540, then short-term loan is 540 minus 240, which is 300, which is what we did, right? So assuming net working capital is so and so, assuming all items have increased in same proportion. Okay, what is increase in fixed asset? Increase in fixed asset is 120, increase in net working capital is 120, minus out of this some amount you get it as profit, that is equity, increase in equity, that is which is 14.4, which we computed initially. Balance is the external fund requirement. Out of this external fund requirement, how much will you get in equity, how much will you get in debt, how long term and short term? We already figured short term debt is going to be 300. So earlier also it was 300, now also it is 300. So there is no increase in short term debt. So what is going to be the increase in? Increase is going to be only in equity and long term loan. And long-term loan increase. What is long-term loan increase? Long-term loan also we figured out is 720 by 1.5, which is 480. What was it earlier? It was earlier 400, now it is 480. So the long-term loan is increase is 80. Long-term loan increase is 80. Short-term loan I just said is 0. Then from equity, external funds required minus long-term minus short-term. So total fund required 225 minus 80, you get 145.6, which is the equity that you should raise. Okay. Then once you have done this, if you are going to raise this equity, let us check if everything is proper on balance sheet side. Your short-term loan is 300, long-term loan is 480, total loan is for 780, share capital is 300, reserves is 200, retained profit is 14.4, and fresh equity raised is 145. So total everything you do 660. So your what is debt equity ratio? Should be not more than 1.5. So let us check. 780 by 660 is how much? 1.18, which is less than 1.5. It's a very tricky, very convoluted question. In fact, I think this is what? This is from Jan 21, and I think the ICA suggested answer solution was not so clear. I think there are some errors also in that. I have followed a different solution which is more logical and clear. Okay, their solution is very haphazard. Okay, so I believe this is the correct solution for this particular kind of question. Okay, let us move to the next one. Now, let us look at this next question. This is again a November 20 question. AB Industries has equity capital of 12 lakhs and debt of 8 lakhs. So, total liabilities is 20 lakhs. Annual sales of 30 lakhs, two mutually exclusive proposals. Exclusive means, what do you mean by mutually exclusive? If this happens, this cannot happen. Both cannot happen together. Okay. Now, the details of the proposals are as we wrote. Target asset to sales ratio in first case is 0.6562. Net margin is given, debt equity ratio is given, target retention ratio of earnings is given, annual dividend is given, new equity raised is given. Okay, and now retention ratio is given for one and annual dividend is given for other. Okay, we will see. Here required to calculate sustainable growth rate for both proposals. What is sustainable growth rate? Sustainable growth rate is G. What is G? G is B into R. What is B into R? B is retention ratio into your ROE. So, you have to calculate retention ratio into ROE to arrive at G. Now, for the company, equity is 12, debt is 8. So, your debt is to equity is 8 is to 12, which is 2 is to 3. Then sales is 30. Okay. Now, in the first case, what is the target asset? What do you mean by target asset to sales ratio? Do we know what are the sales that are going to come from the new proposal? We do not know. Okay, so is this new proposal a new project, or is it changes to existing capital structure and existing projects? We don't know that. So, you have to assume that these new proposals are not necessarily projects. They probably involve some change in existing functioning. Okay, so what is the sales in under new proposal? Under new proposal also assume that the sales is same as old, but there will be change in debt. So, what is the total assets to sales is 0.65. So, asset by sale is 0.65, sale is 30. So, asset is 30 into 0.65, which is 19.5. Okay, net profit margin they said is what? 4%. So, you multiply 4% of that, you get something 1.2 lakhs or crore. This is lakhs, right? Lakhs, yes. Then target debt equity is 2 is to 3. So, what is the equity component of the total balance sheet? If 19.5 is going to be the total assets, same thing will be the total of the balance sheet side also. So, out of this 19.5, you will have 3 by 5 is equity and 2 by 5 is debt. So, if 3 by 5 is equity is 11.7. For 11.7 equity, what is the money that you have earned? 1.2. So, 1.2 by 11.2 is your ROE, which is 10%. And you have a retention ratio of 75%. So, what is the retention ratio? How much money is retained? So, your sustainable growth rate is retention ratio into ROE, which is 75% into your 10.26, which is 7.69%. So, this is how you arrive at sustainable growth in the first case. Now, in second case, target assets to sales is 0.62. Do we know either assets or sales? We don't know. We will come back to that. Okay. There are two ways to work in it. I will just discuss that also. What is current equity is 12. To 12, you are raising fresh equity of 1. So, it becomes 13. And what is the debt to equity ratio? 4 is to 1. That is 1 is 13. So, what is 4? 4 is 13 into 4, which is 52. So, total assets is 65. 52 is debt, total asset is 65. Now, sales based on asset target. That is, if you know this asset value, can you work back at sale? Because asset by sale is 0.65, asset is 65. So how much is sale value? This by 0.62. So it will get 104 as the sale. And what is the net profit margin? Net profit margin they have given us 5%. Okay. So into 5% of this, you get 104 into 5%, you get something around 5.24. And from that, what did they say annual dividend? Subtract annual dividend, you know what is retained. So 0.3 divided by 5.24 is 5.72%. So 5.72% is the dividend payout. So what is retained? 94.28. So 94.28 is retained. So what is your ROE? What is your ROE? ROE is your whatever is the PAT, which is 5.24 divided by your equity capital, which is 13. You get ROE of 40%. So SGR is 40% into 94.28, which is 38. Now there is one more way, which is, can you, instead of working on all of this, can you say target asset to sale is 0.62? Because we have last year asset as, revenue as 30, can you say that asset by 30 is equal to 0.62? So asset is equal to something into 0.62, 30 into 0.62, 30 into 0.62. Asset is 18.6. Can you make such kind of an assumption? See, if you make such kind of an assumption, no, what will happen is, where will your new equity go? If new equity goes somewhere, so if total assets is 18.6, if total asset is 18.6 and your debt equity ratio is 4:1, right? Let us assume 4:1, 18.6. You divide by 5 into, so you get basically 3.72. If you get 3.72 lakhs as equity and you have also raised 1 lakh of equity, is this 3.72 plus 1, 3.72 minus 1? That is first. Second thing, this last year you had 12, how will equity now come down to 3.72? And that too, if it is going to come down to 3.72, why are you raising one again fresh equity? Why will you first buy back shares and again then issue fresh shares? You won't do such kind of jumla. Which is why you need to work like this, which is, even though the target asset to sale ratio is given, you should ignore it for the second aspect. Why? Because there are some other additional information given, using which you have to find out the assets, and from those assets you should find out the sales. Can we do that for the first case? No. There is not much information available for us to do such kind of an exercise for the first case. Okay, so this is a slightly tricky and interesting question, which is why I wanted to do it. You may, if you have any queries on this particular question, right, please think through again. Listen to what I have said. Go through my lectures or go through my notes what I have given. There is a logical way in which we have approached. Okay, I have not randomly taken ratios and multiplied it, because it has to make sense eventually when you multiply those ratios. Numbers have to add up. If numbers don't add up, then there is no meaning. Okay, let us move to the next question. Now friends, let us look at the next question. XY Limited, a cement manufacturing company, has hired you as a financial consultant for the company. The cement industry has been very stable for some time, and the cement companies SK and AS are similar in size and have similar product market mix characteristics. Using comparable method to value the equity of XY in performance analysis, use the following ratio. So using SK and AS, value XY. That is what it is. Okay, be very careful. Use the following ratios: market to book value, market to replacement cost, market to sales, market to net income. Following data is available. Market value 450 crores, 400 rupees or crores, or what is it? They just said rupees. Very weird. Okay. Book value is 400, 300, replacement 600, 550, sales 550, 450, net income 1816. Using this, and they have given some data values, book value, replacement cost, sales and net income. You have to work backwards and arrive. Very, very simple. But there is one trick in this, or one twist in this. See, one of them has a market value to book value ratio 450 to 400. What is how much? 450 by 400, which is 1.125. Other one has 400 by 300, which is 1.33. So how do you value XY Limited? Do you take it as SK, do you take it as AS, or average of both? So you take average of both and compute. So let us see. 450, 400, the ratio is 1.125, market value to book value. 400, 300 is 1.33. So you take average of both, which is 1.229. So you multiply the 250, which is book value of XY, into 1.229 to get the market value of XY, which is 307.29. Twisted way, right? Then replacement cost. What is replacement cost? Market value to replacement cost. Market 450, 600 and 400, 550. What is 450, 600? 0.75. 400, 550 is 0.72. Average of those two is 0.73. So 0.73 into 500, which is the replacement cost of XY Limited, you get the market value of XY Limited, which is 369. Same way, market value to sales. Sales you have 550, 450 and this one is 500. Market value is 450 by 550, 400 by 450. Market value to sales. Market value numerator, sales is denominator. You get ratio of 0.81 and 0.88. Take average, you get 0.85. Multiply 500 into 0.85, you get 426 as market value. Okay, now you are getting various market values. Let us see. Then net income. What is the ratio? Market to net income. What is market to net income? That price to earnings kind of a thing, right? So 450 by 18 is 25, 400 by 16 is 25. One ratio where both are same. So you take this 25 into multiply by 14, you get 350. Now you get various market values or various under various ratios, you got various market value of shares. So what is the ideal market value of the shares? You basically take an average of all of those. 307, 369, 426 plus 360 by 4. You get 363.35. So ratios are taken as average of those two, and the value of x1 limited doing comparable method is taken as the average of all comparable valuations. So you have to write a assumption like this. What kind of question is this? This is old syllabus question, November 19, old syllabus question, but a very interesting question because they have said compute market value, but you get 4 market values. Which market value you take? You will take average. Then market value as per one company, the ratio is 1, another company ratio is 1. Which one will you take? Average of those two. That is what is the learning from this particular question. Very simple question, right? There is nothing complex in this. Then, so friends, now let us look at the next question. This is question number 26. It's a slightly older question, but very genuinely a very good kind of question. Okay, and this again is based on valuing the company using more than one method. And there is a twist in this question. You have to be very careful. There are two companies, ABC and XYZ, same industry. In order to increase its size, ABC made a takeover bid for XYZ. So ABC is bigger, they increase bid for XYZ. Equity beta of ABC and XYZ is 1.2, 1.05. Equity beta. Okay. Risk-free rate is given, market rate is given, growth rate after earnings of tax in recent years has been 15% and 12% for both. So G for both, G, alphabet G, there is growth rate is given. Both companies have continuously followed constant dividend policy. Okay, no problem. Mr. V, the CEO of ABC requires information about how much premium above the current market price to offer for XYZ shares. So XYZ shares are already traded. More than the current market price, I wish to offer a premium. What should be that premium? How do you arrive at that? Okay. Two suggestions have been forwarded by merchant bankers. Two suggestions. They said we'll value it in two ways. First way is price based on XYZ's net worth as per balance sheet, adjusted, considering current value of assets and estimated after profit tax after next 5 years. So this is where the twist is. Directly, I will tell you what the twist. Price based on XYZ's net worth as per balance sheet. So first get net worth. Adjusted considering current value. Okay, you adjust the net worth for increase in value of current assets or assets and liabilities. Any increase, decrease, adjust. And please note the word and estimated profit after tax. So are these two methods or is it a single method combining in both? It is a single method which has first the net asset value plus value of profits. Plus value of profit. So it is a one method in which they are combining two. Okay, this is very careful. This is first alternative. Alternative 1 in which two methods are combined. Then there is alternative 2. Price based on dividend valuation model using existing growth estimates. So second method is dividend model. So please don't think that the first method has again to, so please don't think in the first method that, how will you add value of profits to NAV. We will see how we will do. I will explain that to you. But there can be cases where company can choose to value whichever way they want to. See, it is to be negotiated between the buyer and seller. If they both are happy, we are nobody to say anything, right? So which is why please be careful and read the words carefully. Don't jump. Don't be in a hurry to jump and start writing. Okay, what are the data they've given? They've given a balance sheet of ABC and XYZ. They've equity, current liabilities, dividends, land, current assets. Some data is given. Profit and loss is also given. What this profit and loss is slightly weird profit and loss. They buy net profit. Then they've said to net interest. What is this buy net profit to net interest? So this is not net profit. If it is buy net profit, if it is ideally net profit, the net profit is just before dividends. But here they are saying interest is there, taxation is there, and then distributable profit. So this is basically EBIT. This is basically EBIT. Very poor way of framing question. Ignore. Okay. Then you have distributable profit out of which dividend is paid, and dividend is balance amount is carried down. Balance amount is carried down. Additional information.
ABC's land and building have been recently revalued. XYZs have not been revalued for 4 years. And during this period, average value of land and building have increased by 25% per annum. So XYZ values of land have not been increased. We have to increase. So we have to do some work. Okay. Why? Because we are valuing it at net assets adjusted for changes in prices. Face value of share of ABC is 10 and XYZ is 25. Okay. Why is that required? Probably per number of shares, how much there and all that we can find out. Current market price of share is 310 for ABC and 470 for XYZ. Okay. With the help of the above data and given information, you are required to calculate the premium per share above XYZ's current price by two methods. So one is dividend discount method, other one is NAV plus profits method. Discuss which of these two values should be used for bidding. State your assumptions clearly. So obviously there are a bunch of assumptions. Only when we get into the problem deeper, we will understand. We'll have to figure out. But you see, when they have said here, first part mein, net worth plus value of assets and estimated after-tax profit. They've said estimated after-tax profits for next 5 years. Is it present value of after-tax profits? Yes. Now, are we valuing the company or are we valuing the share? We are valuing the share. So, should you do FCFE or FCFF? Here, what is happening? We are finding out net value of net assets. If this is value of net assets, that is already equity value. So, when you find out PAT, for net profit after tax, estimated profit after tax, it is for the it is not for the entity, it is directly for the shareholder. So there is no FCFF, FCFE wala confusion. It is very clear, it is for the shares only. Okay. Now let us move forward. We'll make certain assumptions as we move forward. We have to first do a NAV based valuation of XYZ. Why are we doing only XYZ? Because we have to quote a price for XYZ. So ABC is not required. What are the details of XYZ? They have land and building 1500, plant and machinery 2800, and land has to be grown by 25% per year for previous 4 years. So 1500 plus 25% for 4 years, that is 1.25 whole power 4, you get 3662. Then plant and machinery 2800, receivables 2400, stock, cash, everything. You put all the details that are there. Now, please note here, when they say dividend payable, here also they have given one dividend payable in balance sheet, and here also they have sent some dividend in P&L. Which one should you consider for net asset value? You should consider only the dividend payable in the balance sheet. This distributable profit and subsequent dividend, we don't know how much is interim, how much is final. Probably interim is already been paid off. It's very, in the overall year's balance sheet, it is showing us to dividend. They're not saying dividend payable, but here probably this in the balance sheet, whatever dividend payable is, that refers to the final dividend. We don't know. So in this kind of scenario, you have to make an assumption saying that the dividend payable in the balance sheet is being considered as the dividend that is outstanding. Okay, so you take that dividend and arrive at the total NAV. So far, so good. These are all very simple. You're just taking directly the book values of all the assets are given and book values of all liabilities. You have subtracted for all the liabilities. You have increased the value of the land and building by 25% per year, and you got 8,000. To this, what do we have to add? Because we are talking about equity, you have to add PAT. PAT for how many? Next 4 years or 5 years? What did they say? Next 5 years. What is the PAT here? They've given a PAT, no? Post taxation, what is the distributable profit? Distributable profit is 1510. That is what you have to consider as PAT. 1510. And what is the growth rate for XYZ? XYZ, they've given a growth rate. XYZ is 12%. So you take that 12%, compound the tax every year by 12% for next 5 years. Okay, then you take present value. How will you take present value? What data do you have? They have given equity beta. Equity beta of XYZ and ABC. So if they've already given you equity beta, do you need to again relever, unlever and all of that? No. If they've given you equity beta, directly take that as the beta. So you compute cost of equity as risk-free rate plus market risk premium into beta. So here beta is 12. What is market risk premium? Here beta is given as 1.05. I'm sorry, I said 12. Beta is given as 1.05. And risk-free rate 10%, market return is 16. So 16 minus 10 is 6. 6 into 1.05 plus 10. So how much will you get? You will get a discount rate of 16.3%. So at 16.3%, you'll find out the present value factors for 5 years. And then multiply this, whatever is the PAT that you've got, which is increased by 12% per every year, multiply with this. Now, do you take terminal value? No, you do not compute any terminal value. There is no concept of valuing the entire future. We are only valuing next 5 years profit, which is growing at 12%. So you take next 5 years values, take their present value factor, you get some sum of 6,700 right? 6,700. And the book value of all this is individually if taken is 10,000. Now, should you consider 6,700 or 10,000 to be added to 8,300? In my opinion, you should consider only 6,700 because you have to, just because you're taking next 5 years PAT doesn't mean you take the 5 years PAT at their future values. You should take them at present values. So 8,300 plus 6,700, you get 15,000. Now 15,000 is the, what is it in, what is the metric? Rupees, lakhs, yes, everything is in rupees lakh. This 15,000 rupees lakh, basically 150 crores. How many shares are there for XYZ? There are 1,000 lakhs of shares, that is 10 crores of shares. And what is the price per share or the face value per share? Face value per share is, they've given somewhere. What is the face value per share? 25. So 10 crores divided by 25. 10 crores divided by 25 will give you roughly about 10 crores divided by 25. Please, if you can do it mental math, good. Otherwise, my suggestion is a crore is 70, 10 crores is 8 zeros. Okay, so 10 crores divided by 25. Please do it on calculator. Calculator is available. 40 lakhs. So 40 lakh shares. 40 lakh shares. So 15,000 by 40 is 377.81. What is the price per share in the market of XYZ? 470. This is not even recommending a premium. It is recommending a discount. Okay, we will see. What is the second method? Dividend discount model. What is dividend discount model? D1 by KE minus D. What is D1 first? This year dividend is how much? This year dividend. This is why they have given what is the dividend for the year. 760. So this 760 is the dividend, total dividend for the year for particular company called XYZ. How many shares are there? 760 lakhs divided by 40 lakhs. So your dividend is 19 rupees. This 19 rupees is going to grow by what percentage? Here they have given is going to grow by 12%. Is going to grow by 12%. So 19 into 1.12, 19 into 1.12, whole thing divided by KE minus G. What is KE? KE we already found out. KE is 16.3. We found out for the previous part of the question, minus G of 12%. So you get 494. 494 is the price as per the second method. Now, first method is giving 377, second method is giving 494, and the market price is 470. Correct? Current market price is 470. What is the premium? The first method is giving you a discount of 19%. Second method is giving you a premium of 5%. You have to specifically state. Now they've asked, what is your opinion? Under method 1, if it is considered premium does not exist, not an appropriate way. Under method 2, premium is 5% and it appears appropriate. ABC can also evaluate synergy from business instead of valuing purely on cash flow. So we have not been given what are the synergies. So these are the value-added points that you write in exam with respect to specific questions on business valuation or M&A, where where the examiner also knows, or probably even ICA will probably have some marks for it, where you give that additional value add. First, we have considered only future cash flows. We have not considered any synergy. If you make that one point, you're in the views of the evaluator, or if ICA asks, or if ICA has that particular point in their exam suggested key, you will get those marks. Okay, so what is the final suggestion? The second method seems appropriate. The first method does not seem appropriate. Okay, fair enough. This is question number 26, what you have solved. Let us move to the next question. So friends, before we go to the next question, there are some topics or concepts in the chapter which are slightly theoretical, but which are required from a career exam and even a problems perspective. So one is called leverage buyout. Okay, what is a leverage buyout? There is a PE firm or some kind of an acquirer who's planning to acquire a target company. And what they do is, instead of putting their own money to acquire the target, they will raise debt. They will raise debt, that is from the market or from the banks. They will raise some money. That money they will use to buy the target company. And when they use it, they basically are giving it to the shareholders of the target company. So they will give it to the shareholders of the target company and buy the shares in the target company from the shareholders. But what is the security or collateral for this debt? The security or collateral for this debt is the assets of the target company. So they will structure a deal in such a way, basically whether it is, friendly takeover, hostile takeover, whichever way. You will learn more about it in the next chapter, M&A. That particular leveraged buyout. Leverage means what? Leverage means raising using debt. Leverage ratios you would have studied, right? So using debt, raising capital using, raising finances using debt, or raising finance using debt is called leverage. So 70 to 80% of the cost of acquisition is loan raised by pledging target's assets. And 20-30% is their own equity. Typically large PE firms like KKR, Blackstone, all these guys do it. And this works. Where does this work? Where cash flows, future cash flows are certain. Where future cash flows are uncertain, it does not work. Why? Because how is the debt serviced? See, debt is secured by pledging the target assets as collateral. If the debt is not repaid, or how will you even repay the debt? How will you service the debt of interest or principal repayments? By cash flows generated the target. So if the target, that is the business that you're acquiring, has good cash flows, potential cash flows, every year it is generating, 100 crores, 200 crores, whatever the number, then you can take a loan based on those cash flows, pledging the target's assets. If the target is not going to generate cash, it's going to be a very difficult proposition. Okay, so works where future cash flows are certain, targets will be stable, non-cyclical, long-cyclical and predictable businesses, and one can go for an LBO. Only in that cases you can go for an LBO. There is something called as management buyout. What is a management buyout? Instead of an external acquirer, the existing management themselves goes to a PE firm. PE means private equity firm, and says, see guys, we want to take over this company. We as management want to take over. You please raise the loan. We will, buy out the shares from the existing shareholders. We will, this loan, whatever we have, we will service it from the company's current cash flows. We are confident that we can run this business well. So when the management takes this decision, instead of an external player coming in and doing, the internal players only approach an external player and buy out the existing shareholders. That is called as a management buyout. And management incentives are aligned towards organization. That is why it succeeds. So when will the managers make money? When the company starts working well, or when the cash flow start generating, you repay the debt, the company grows and all that. So managers take ESOPs or stakes or something like that in the company, and they work well. Okay, the top management. Again, it is not manager means not every down the line chain factory manager. Whoever is important, top 10 people, 20 people, 50 people. Okay, management buy-in. What is a management buy-in? Management buyout, management buy-in. Management buy is when a PE brings in new management to replace the old management in LBO, it is called management buy. So instead of letting the existing management run, the PE firm who's doing an LBO gets a new management, gives them ESOPs or gives them stakes in the company and says, you run. You also gain, we will also gain. That is called as a management buy-in. Okay, so this is a very interesting concept. We have discussed about this exit multiple chop shop method. Now let us go to other important aspect which is there in this chapter, from which good amount of questions are also asked. This is economic value added. What is economic value added? See, it is not strictly a valuation basis. Okay, valuation we saw asset based, then cash flow based, then relative valuation and all that. Economic value added is not a valuation. It is in an entity, in an enterprise, in a business, what is the value that is being added, okay, to all the stakeholders. It is not the value per se of all the stakeholders, but value that is being added to them. Okay, so it is not like what is your net worth, but what is your monthly income. Okay, simply put. Okay, so that is one way to look at it. Now, what is a value, economic value added? NOPAT minus capital charge. What is NOPAT? Net operating profit after tax. It is after tax, PAT. What is operating profit? EBIT. So EBIT means before interest. So profits before interest, but after tax. That is post-tax profits that are eligible for post-tax profits in which all the stakeholders have a stake. That is your debt, preference, equity. That kind of profit, post-tax profit, minus your capital charge. Capital charge is invested capital into WACC. Invested capital is, your equity and debt or capital employed. They will give you what the invested capital is. Okay, invested capital into WACC. WACC, why? Because you're doing both for equity and debt holders. Okay, so what is the value added by the business? This year, I generated this much NOPAT. This year, this is my cost of capital. What is the incremental value added? Right. So that is what we are doing here. And what is invested capital? Equity plus debt. That is total assets minus non-interest bearing liabilities. And please note, all are book values only. You are not taking anything at market values. These are all book values. Economic value added is all about book values. Please do not forget that. Then you also have to remember both EBIT and invested capital have to be adjusted for non-cash charges other than depreciations, like provision for doubtful debts, P&L adjustments, so on. So your EBIT should be EBIT that is adjusted. That is, if there are any non-cash provisions, I'll give you example, prior period expenses, extraordinary item, okay, some kind of non-recurring item, okay, you'll be given those in the question. Even in real life, that is what you do. You take out things which are non-cash, largely non-cash, and you adjust for them. Why? Because you're looking at current year's operations. And non-cash, again, please note, we're not going to subtract depreciation. We're not going to ignore depreciation. Depreciation is a part. Why? Because you have both equity and debt holders are the ones who finance the assets. So there has to be a recovery even with respect to the the cost of the depreciation charge on those assets, which is why depreciation is not added back or anything like that. It is considered as an expense. So other than depreciation, everything, all other non-cash charges are adjusted. And they should be made on post-tax basis, and corresponding balance sheet items like equity, current asset, current liability should also be made. All adjustments should be made on post-tax basis. That is, let us say there is a non-cash charge. There is some provision of 10 lakhs. Tax rate is 30%. So when you do this provision of 10 lakhs, they have to specify whether this 10 lakhs is pre-tax, post-tax. If they don't tell you, you have to make an assumption. Okay, what I've done in quite a few problems is I have done everything both post-tax and pre-tax basis, because it is just 3-4 lines that you have to work out. Okay, so I do both of them. It makes life simpler. Whatever the evaluator, examiner wants, they will see. Instead of looking at it, whether it is pre-tax, post-tax. ICA has made some blunders. In some questions, they've adjusted everything pre-tax. In some questions, they've adjusted everything post-tax. That is not fair. No. Anyway, my suggestion always do both of them in the exam. It will not take you more than 5 minutes extra time. Okay. This you'll understand better when you see this when I show you an example. Then there is second concept called market value added. Market value added is market value of equity and debt less invested capital. So it is basically market value minus book value. Difference of market value minus book value. And debt, more often than not in India, we don't get market value because very few companies raise debt by issuing bonds, or even if they raise, it's a very small portion of their overall debt. Large portion of debt is bank debt. So book value of equity versus book market value of equity is typically the market value added. Okay, if they've given you the market value of debt and book value of debt, then you can add the market value of debt also to market value of equity. Then you have something called a shareholder value analysis. Shareholder value analysis is basically your enterprise value logic. What is enterprise value? You take, we discussed about this earlier also. I explained you the process. You first arrive at FCF. And what FCF is this? This is free cash flow to firm, FCFF. Then you discount using WACC. Why WACC? Because to the firm. Then you add terminal value to the existing free cash flows. Take some 5 years or 6 years, whatever seems appropriate or whatever is there in the question, you add that. Then what you get is enterprise value of the entire business as a whole. From that enterprise value, you subtract the value of debt, you get the value of equity. Right? Business, pure business operations, subtract the value of debt, you get value of equity. But to that, you have to add value of surplus cash that is lying, or surplus cash or any non-core investments that are lying, which are not generating any revenue, which has not been considered here in FCF. So the logic is also that is, income on other interest income and all, other income and all that is not considered in FCFF. FCFF is pure EBIT into 1 minus tax rate. You're not considering interest income, dividend income from unrelated investments in some foreign company or domestic company or some 5% stake in some company. All that is not considered when you compute FCFF. It is directly EBIT into 1 minus tax rate. You don't do EBIT into 1 minus tax rate plus other income. You don't do that. Right. So which is why this surplus cash investments pertains to that other income, which is not considered in FCFF. So you add that to the value of the equity. Why are you not adding it to the enterprise value? Enterprise value is value of the business. Equity value is value per share. Shareholders have a right over all other additional income that is generated by the company, even though it is not pertaining to operations. Whereas when you value a business, you're valuing the business for purely, if somebody has to set this business with a factory and all of that, without any unnecessary surplus cash or unnecessary investments, then what is the value? That is why EV does not have the surplus cash, whereas market cap, which is EV minus debt plus cash plus non-core investments, has those values in them. So this is shareholder value analysis. When we say shareholder value analysis, we are basically saying, how are you going to arrive at the value of equity, considering the business, considering non-core and other aspects also. This is SVA. Then now we have discussed varieties of methods, multiple methods. How do you arrive at a fair value? You can do NAV based, you can do current market price, you can do DCF, you can do net realizable value. NAV is net asset, NRV is net realizable. Please note the difference. All the methods of arriving at fair value have inherent challenges. It's always better to have a range of values. So when you look at any valuation report, if you go and search for valuation reports, I've given in my full course also. So the CFA firm gives a report saying the fair value of this business is between 10 rupees to 12 rupees. So, and the acquirer buys it at 11 rupees. Yes, it is in the fair value range. A lot of people give exactly a range. Only in the stock market, you have people who would say the value of the share is 212 rupees. All equity research analysts say things like that. Okay, that is because they're supposed to say. But if you look at any original valuation reports of any of the professionals who give out, they give broad ranges because they use multiple methods. Or they say we'll take weighted average of these. Okay. Then fair value is one which is minimum acceptable to the seller and maximum payable by the buyer. So fair value is not necessarily something which is known. It is something that is transacted at, right? Then for a CA, it is arm's length price. What is the price at which transaction happens? For an analyst, it is present value of cash flows. For analysts, whoever is a equity research analyst also, it is present value of cash flows. For a speculator, it is the one which opens up arbitrage opportunities. So it is the one at which there is no possibility of an arbitrage. That is, it ensures that there is no too much gap between what the market is saying and what you are trying to value. Right. So that is one. Then you use multiple methods to arrive at a range. You provide comments for each method, arrive at a final conclusion based on any additional info. This is what typically valuers do. You can look at any of the valuation reports issued by CA firms for any of the large mergers that have happened. Now, this is one very, very important aspect which is added in the new syllabus. Okay. Valuation of distressed companies. And there are no questions given in this as of now. But I believe that at certain point, ICA will add questions in the study material for this, because this is a topic, I think, which has some potential for questions. For the moment, there are no questions. As long as you remember this logic, even if they ask a question, it will be a simple question, because I've seen this in advanced capital budgeting and a bunch of other new topics wherever they've introduced real options and all. They're not directly asking a very deep question. Okay, when they start asking questions, initially they will ask easier questions, and over a period of time the questions will get slightly tougher. At least for the next few attempts, I believe that they will be asking upar se some kind of broad questions on this, not too deep questions. So conceptual learning is important here, not necessarily practice of these, because there are no questions that are given. Even if there are questions that are given, I'll have to create on my own. That is not required at this point. What is this distressed company valuation? First of all, what is distressed company? The distressed company is something which has high debt levels, which has high debt levels and high OPEX, or is facing a revenue downturn. Because of all these three, or because of any of these three, it leads to delays in payments. That is, there are delays to payments to salaries, vendors, lenders, everybody. This does not mean the company is worthless. It absolutely does not mean the company is worthless. It means the company is under some trouble, okay, but doesn't mean that the company has no value. Now, in case of distressed companies, how do you value? Estimating cash flow is tough due to declining revenues. Because of some problem, revenues are declining or there is no cash flow. Terminal value is difficult as immediate cash flow may be negative. This is also a reality. Therefore, one cannot use DCF. If you can't use DCF, what will you use? Risk of bankruptcy is very high, correct? Discount rates reflecting probability of failure should be used. So, we should take discount rates for discounting the cash flows that also have factored in the probability of failure. How we will do, how we will use that, all of that we'll discuss. But generally remember, when you are valuing distressed companies, you have to consider, because cash flows are unreliable, terminal value cannot be calculated, cash flows will quickly turn to negative, there's a high risk of bankruptcy. You have to, the discount factor for the cash flows has to be high. It has to reflect the probability that the company may go bust. Okay, now let us see what is the distressed company valuation. Okay, first there is something called as, you have to understand going concern value, then we'll come to distressed company valuation. What is a going concern value? Going concern value is whatever is your liquidation value plus present value of cash flows plus value of goodwill and other intangibles. So your present value of future cash flows plus any debt plus intangibles, this plus original liquidation value. What is this liquidation value? Again, liquidation value is net value of assets minus value of liabilities. So what is the value of net assets and values of net liabilities? Basically, it is your book value. Okay, what will you get? Okay, it is, if you sell it out, what will you get? Will you have to make some adjustments? Yes, probably you have to make some adjustment for some realization, but that is liquidation value. Now, what is liquidation value's linkage to this going concern? Liquidation value plus some additional things is your going concern value. Then what is not going concern value? Not going concern value is basically your distressed company valuation. What is not going concern? That is, when your company is distressed, then you do valuation. Before we move to distressed company valuation, we have to understand why is this impact of non-going concern value. That is, why is the non-going concern value only assets and liabilities? Why is it not other aspects? It is not other aspects because there is an impact of bad reputation. If you know that the company is not going to survive or there's going to be some issue, obviously the reputation, the goodwill will have a take a hit. So you can't value goodwill. The critical employees are laid off, so you don't know which employees will continue. Without key employees, how will you survive? Then very low realizable value for assets. So assets, when you sell, you don't get the actual value. You are adjusting book values to some kind of market value adjustment. That's all, and no value for intangibles, which is why your liquidation value is your base. Then this liquidation value, we have explained the reason why liquidation value or non-going concern value has this reason. Now let us come to distressed company valuation, which is where the non-going concern value is taken into account. How do you do that? You have three methods. Modified you have four methods. Modified DCF, DCF plus distress, APV, and relative valuation. So there are four methods using which you value distressed companies. Okay, in which non-going concern valuation is used. That is one particular input. What do you do for distressed company valuation? So what is this first method, modified DCF? Let us understand. Estimate probability distribution for all cash flows. What do you mean by distribution? We'll see. Arrive at expected cash flow. Arrive at revised KE based on updated DE and unlevered beta. Estimate KD. Unable to estimate entire distribution, probability for each period to be estimated as below, and so on and so forth. They said expected cash flow T is equal to cash flow T into 1 minus probability of distress. How is this done? We will understand. Let us take, these are, first method is modified DCF. There are 5 years. Okay. Terminal value and all we'll ignore for a moment. You have these cash flows. Every year there is this cash flow, 10, 20, 30, 50. For each year, they are saying arrive at a probability distribution. That is for year 1. Probability distribution of cash flow. That is, this we are thinking it is 20. How did we arrive at 20? They are saying cash flow of 100, cash flow of 80, cash flow of 50, cash flow of 20, cash flow of 0. In the first year, probability of this is 5%, this is 10%, this is 80%, this is 5%, this is 0%. How much does come to? 16 plus 2, 18.5 plus 8, 28 plus 5. So this probably is 33. Okay. So like this. How did you get this value? You multiply cash flow into probability for each year. Now for next year, what will be? Let's say next year, this is 10%, this is 20%, this is 10%, this is 50%, 50, 40, this is 10%. Multiply this 100 into 10, 80 into 20, 15, 20, like that. This may have a different cash flow profile also. Okay, problem, right? So you multiply every year's probability distribution of its cash flows and arrive at a cash flow. That is what expected cash flow. This is expected cash flow. They are saying arrive at expected cash flows like that. Okay, that is one way. If you can't arrive, they will tell something else. But first, this is what they are saying, arrive at this. This is what you have to remember. Then, what is the next thing? Arrive at expected cash flow for each period. Arrive at revised KE based on updated DE and unlevered beta. So, you currently have some cost of debt, cost of equity, some beta. And so basically, debt is to equity. Please recompute based on new reality. What is new reality? Old debt equity is, let's say, is 1:1. New one may be 1:2. Who knows? Why? Because you are repaying more debt. Okay. Then, or you may take more debt. Either way. Okay. Then beta. What do you do with beta? You first take unlevered competitor beta and then apply this debt equity ratio there and arrive at new equity beta. Okay. Then use this to arrive at cost of equity. Then arrive at cost of debt normal plus probability of default. Why? Because you are a distressed company. You are in some trouble, right? So estimate KD based on updated measures of default. Arrive at KE based on updated DE and unlevered beta. So they're saying everything update. Please update everything, including cash flows. Please update everything. And then you find out the value. Then you find out the value. That is discounted cash flows. How will you discount the cash flows? Using this debt equity, you'll arrive at a WACC. Using this WACC, you will discount these cash flows. You will discount this cash flow. That is what they're saying. Very simple, right? Update everything, take probability and discount. This is first part. If you don't have this, that is the second part. If unable to estimate the entire distribution, probability of distress for each period to be estimated for each period and used as below. So they're saying if you are unable to estimate for the entire distribution for each year, what do you mean entire distribution? That is 105%, 80, 10%, 55% for first year. For second year, how much percent, how much percent, you don't know. So they're saying unable to estimate the entire distribution, probability of distress for each period to be estimated for and used as below. That is, for each period, what is the probability of distress? So estimate what is, if what is the probability that something will go wrong. So basically, it is a very simple way to look at it is, instead of having so many percentages of cash flows and all, tell me there is a 50% chance of 100 cash flow. So actual cash flow is 100 into 1 minus 50. Or there is a 60% chance of distress. So if chance of distress is 60, this is distress. So 1 minus distress is 40. So 100 into 1 minus 40. Okay. So 100 into 1 minus 60, I'm sorry, 100 into 1 minus 60, which is 1 minus 60 is 40, 100 into 40, which is 40. So this 40 is the cash flow for each period. Like that, you arrive at cash flow. And then again, apply KE, KD, WACC, beta, all of that normal. This is called modified DCF. Okay. This is something that you should remember. Then you have another method called DCF plus distress value. This is another method. What is this? DCF overstates value if there is probability of failure. If the company is going to fail, a DCF, if you keep on projecting till terminal value, obviously you'll get a higher value. Don't do that. So value of business as going concern, which is value of equity. So first value as a going concern. Then make adjustments. What adjustments? Determine probability of distress over lifetime. What is the average probability? So I will arrive at the value of, let's take simple example, HUL. HUL today's value is 10,000 crores. What is the probability that it will go bankrupt? That is 1% probability. Okay. If it is 1%, let us see. Estimate the distress sale value as percentage of book value or percentage of DCF. So we'll take example of HUL, because HUL is very easy to do because probability of distress is very low. It's very easy to take an example and explain this. So DCF plus distress, HUL non-distress value. Let's take 1 lakh crores. Probability of distress 1%. Okay. Then what did they say? Determine probability of distress. Estimate the distress value as a percentage of book value or percentage of DCF. So distress value. Okay. Either 90% of book value or 50% of market value. So we don't know book value. Assume market value is 1 lakh crores. 50% of that is 50,000 crores. Okay. This is distress value. Then value of equity. That is how we'll arrive at the value of equity. DCF value of equity, which what we originally found out, that is 1 lakh crore into 1 minus probability of distress. So 1 lakh crore, 1 lakh CR into 1 minus 1%. That is 99K CR. Correct. 1% of 1 lakh crores is 1,000 crores. So 99,000 crores plus distress value into probability of distress.
50,000 crores, which is the value in case of bankruptcy or distress, into 1%, which is the probability of distress. So you'll get 500 crores. So the total value will be 99,500 crores. Value of HUL will be 99,500 crores.
And I've taken here HUL because there is very low possibility of distress. Take some other company which has a high probability of distress. Then you'll get a very different value. Correct. This is second thing that you should remember. Then you have some new concept. This, I think it was there in the old syllabus of FM. They've now removed it. Adjusted present value. What is adjusted present value? You are basically taking financing decision and your business decision independently. What do you mean? Let us see. Investment and financing decision separated. Compute unlevered firm value by discounting FCF at KE. So KE means equity. Compute present value of expected tax benefits of debt. Expected bankruptcy cost is equal to unlevered value minus distress sale value into probability of distress. That is, firm value is unlevered firm value, unlevered value of equity, plus tax benefits of debt. From debt, you may get some tax benefit. Debt, when I say debt, because there is borrowing, the interest cost on the borrowing, there is a tax benefit. No, that accrues to equity holder. Correct. That one minus expected bankruptcy cost from debt. So APV is equal to business value plus tax benefit on debt plus, what is the third one? Bankruptcy cost from debt. Please note it. Please note it is bankruptcy cost. These two are positive. Cost. Okay. Bankruptcy cost from debt. Is it plus? Is it minus? It is minus. That is what I was thinking. It is minus. minus bankruptcy cost. So you're subtracting cost from benefits. What is this normal business value? This is simple FCF. Okay, there's no complication in it. What is tax benefit of debt? It is basically your T into D. Okay, whatever is the benefit that is going to accrue from the debt. Think of your debt as perpetual debt. Debt is perpetual, then interest flows are every year you get the interest flow. So on interest flow, every year you get a tax benefit. So you basically are multiplying the T into D. Okay, so that is tax benefit on debt. Finally, what is this bankruptcy cost? Bankruptcy cost is expected bankruptcy cost is unlevered firm value minus distress sale value into probability of distress. So here you've got unlevered firm value. First one is unlevered firm money, no? Unlevered firm. So unlevered firm, let's say, is 1,000. 1,000 minus distress sale value. So how did you arrive at distress sale value? You have arrived at a distress sale value here. Distress value. Estimate the distress sale value as a percentage of book value or percentage of DCF. Okay. Or, right, percentage of DCF value or percentage of book value. Something like that you arrive at. And you subtract these two. Let's say distress sale value is 100. Distress sale value is 100. Subtract these two, you get 900. This 900 into what is the probability of distress? There is 5% probability. So that is 5% into 900 is what? 595 are 45. That is 445. So you subtract the bankruptcy cost as 45. So this 1,000 plus, let's say T into D is 200. 1,000 plus 200 minus 45. That is how you arrive at a value of a company which has probably some minor distress lying up ahead. Okay, and this is adjusted present value method. This is adjusted present value method. Now comes the easiest of all, which is relative value. Use revenue or EBITDA multiples. Why? Because if a company is in distress, obviously PAT will not be there. Okay. Then PE, PB cannot be used. Price to earnings or price to book cannot be used. Book value may be negative, earnings may be negative. Subjectively adjust the multiple of a distressed company while comparing to industry multiple. So if you are valuing HUL and some small distressed company of which is in same FMCG, HUL has a PE of 25. Will you assign the same 25 PE to this company? First of all, you cannot do PE, but you have to do revenue multiple, that is price to revenue. HUL has 10x price to revenue. Will you assign same price to revenue of 10 to this small Chutku company which is facing distress? No, you'll say, boss, HUL is HUL, first big company, not in distress. There are so many other factors. So I will value it at 3 times of its revenue. So you'll say 3 versus 10. Why 3? HUL is at 10. I am a small company in distress. So I will value it at 3. This is subjective. This is very subjective. Right. So this is another way in which you do relative valuation, basically relative valuation, which you do for valuing a distressed company. Right. Now we have seen distressed company valuation also. Let us go and solve problems before we go to startup valuation. Startup valuation is the next topic. There are a bunch of slides on startup valuation. It's also a very interesting topic. And then you also have ESG and all that. We will look at all of that. But first, let us go and solve a couple of problems on this whole EVA and shareholder value analysis and all of that. So that, that concludes a large portion of our problems. Then we can come back and look at these theoretical aspects. So friends, now let us look at this question. This is related to the EVA concept that we just learned. The following information is given for 3 companies that are identical except for their capital structure. Invested capital is 1 lakh for all of them, but debt to asset ratio is different. Debt to asset means debt by debt plus equity. Shares outstanding are different. Pre-tax, cost of debt is different, cost of equity is different, and EBIT is same. EBIT is same, but capital structure is different. Now, will PAT be different? Of course, because your interest costs are going to be different. Tax rate is uniform 35% in all cases. Very good. Compute the WACC for each of the companies. Simple, we'll do it. Compute EVA for each company. What is EVA? NOPAT minus capital charge. What is NOPAT? EBIT into 1 minus tax rate minus WACC into invested capital. Based on the EVA, which company will be considered as best investment? Give reasons. We will see which has highest EVA. The industry PE ratio is 11x. Estimate the price per share of each company. So please find out the PAT for each company, and based on the PAT, compute the EPS. Based on the EPS, compute the price for each share. Calculate the estimated market capitalization of your company. So once you computed the price per share, multiply with the number of shares. Okay, you get the market cap. It is a mix of bunch of concepts. Now, what is invested capital? They've given us 1 lakh, 1 lakh, 1 lakh. Agreed. Debt to assets, that is debt by debt plus equity, is 0.8, 0.5, 0.2. So what is total debt? Total debt is 0.8 into 1 lakh, 0.5 into 1 lakh, and 0.2 into 1 lakh. What is equity? Difference of these two. So 20,000, 50,000, 80,000. What is debt percentage? 80, equity percentage 20. Obviously, we can look at it and figure that out. What is cost of debt? Cost of debt pre-tax is 16%. It is before tax cost of debt. They very specifically said pre-tax cost of debt is 16. So what is post-tax? Post-tax cost of debt is 16% into 1 minus 35, which is 10.4. Like that, you find out for all three companies. You found out the post-tax cost of debt. Wait, see, these kind of questions are simple format driven. Multiple times we have seen this in November 24 paper. You stick to a format, you'll get the answer. Then KE. What is KE? They've given KE as already a number has been given, which is 26, 22, 20. So what is WACC? WACC is weight of equity into cost of equity plus weight of debt into 1 minus tax into cost of debt or post-tax cost of debt. So WACC is 10.4 into 80. What is 10.4? 10.4 is your post-tax cost of debt, and debt is your 80%. So like that, you found out the WACC. WACC is 13.5, 15, and 17%. I'm not going to do this multiplication because that is not going to add value to you. What is going to add value to you is key points in this, which you should remember when you are solving the problem. Then EBIT. Please remember, EBIT is before interest. So obviously, EBIT is same for all of them because they all have same business. They are earning same profits at EBIT level, but their capital structure is different. So EBIT is same. What is NOPAT? NOPAT is EBIT into 1 minus tax rate. So for all of them, tax rate is same. So for all of them, EBIT, NOPAT is also same. Where do things change? NOPAT minus WACC into invested capital. That is where things change. What is invested capital is also same, but WACC is different. So for one of them, it is 13%, one is 15%, one is 17%. So you multiply that WACC into invested capital, you get the capital charge. You subtract this capital charge from NOPAT, you get the EVA. EVA is 2,700, 1,025, and minus 1,700. So what are the questions that they have asked? Compute the WACC, computed. Compute the EVA, computed. Based on EVA, which would be considered best investments? This obviously EVA, based on EVA, Orange has highest valuation, hence invest in it. Okay, that is best investment. Second one is slightly lower, third one is negative. So that is also done. So third question is also done. The industry PE is 11x. Industry P is 11x. Estimate the price of share of each company. Have they given number of shares? Yes, they've given 6,100, 8,300, so on and so forth. So what did we get here? So far, we have got EBIT from EBIT before interest. So you subtract the interest cost. How do you get the interest cost? Whatever is the interest percentage. What is interest percentage? They themselves have given 16%. This is pre-tax cost of debt. Okay, interest cost is pre-tax. So 16% into 80,000, 13% into 50,000, 15% into 20,000. You subtract the interest cost from EBIT, you get PBT. From PBT, you subtract the tax of 35%. So everywhere you subtract tax, you get the EAT or PAT. PAT is, which is what metrics are these? They have not said lakhs, rupees lakhs, nothing, right? They have not said anything. But you have the share count directly. So divide by 6,100. So divided by 6,100, 8,300, 10,000. So you get the
EPS. This EPS,
you multiply by the PE multiple of 11. So you get the price of share of 14, 15.94, 15.73. Based on this, again, compute the market cap, which is the market cap you multiply with this share count. So 6,000, 8,300, 22,000, you get market cap of 87,000, 1,32,000, and 1,57,000. Which has the highest market cap? Last company has the highest market cap. Ideally, they would have different PE as their capital structures are different. So this is an additional point that we wrote. Calculate estimate market capitalization for each of these companies, correct? But if the capital structure is different, the sensitivity of their cost of equity is going to be different, correct? When cost of equity is different, don't you think their PE ratios will also be different? Obviously, because PE ratio is based on whatever is the capitalization of future earnings. Earnings are dependent on your debt also. Just because your business is same and the invested capital is same and the business is making same operating profit, doesn't mean you'll have same PE. You'll have different PE. So these are the kind of things that you should remember. Okay, this is a very simple question for EVA computation. I didn't want to get to, there is one more question that, there are one or two more questions that we will solve, which may have slight variation, but EVA as such is a very simple concept. If you understand it, very good, no problem. It's a super simple sixer question in the exam. Okay, let us move to the next question. What is this? This is a December 21 question. Following is information of Mrs. DY Limited. As on March 21. Sales is 1,000 lakh, OPEX including interest. Operating expenses including interest, that is all expenses plus interest, is 620 lakhs. Debenture, 8% debenture, 250 lakhs. Equity share capital is 250 lakhs. Market value of equity plus debt. They themselves said market value of the equity and debt, Typically, they have to specify this in exam hall. If they don't specify, no, whether are we talking about the entire business? Are we talking about equity? We don't know. Okay, you have to look at the question and then make a suitable assumption. See, if they've given the market value of just argument's sake, they've given market value of DY Limited and they just say 200 crores. What is the equity share capital? 250. Market value is 200. Do you mean the 200 is value of equity and debt? How is it possible? Because debt itself is 250. At that point of time, you have to make an assumption that the market value they've given is pertaining to equity only. Okay, please make assumptions that are rational in light of the rest of the information given above or given elsewhere in the question. Don't make random assumptions that have no logical basis. Here they have specified equity and debt, so it is both together. Reserve and surplus is 250 lakhs, corporate tax is 30%, risk-free rate is 7%, market return is 12, equity beta is 1.4. You are required to compute WACC, EVA, and market value added. What is market value added? Market value of debt and equity minus book value of debt and equity. That's all. And EVA and WACC, obviously, we can compute. Is that it? Yes. This is a simple question. Okay. This is again a question where I want you to get refreshed to the concept. I'm not here to, there are no twisted questions also in this topic here. In fact, both business valuation and M&A chapter is very, very simple formula-driven, format-driven stuff. What is WACC? You have this 7% risk-free rate, 12% market return. So 12 minus 7 is 5. 5 into beta of 1.4 is 7. 7 plus risk-free rate of 7. So your cost of equity is 14. Correct? What is cost of equity? Yes, cost of equity is 14. Then what is your cost of debt? Cost of debt, 8% debentures. Obviously, when a coupon is given, that is pre-tax only. So 8% is pre-tax. Tax rate is how much? Tax rate is 30%. So post-tax is 8 into 70, which is 5.6. Correct? Okay. Then what is WACC? WACC is, how do you compute WACC? Do you compute WACC based on book values or market values? See, typically when you do valuation and other exercises, you take market values. Here, have they given the market values of equity and debt separately? No, they are not given. Right. So you take book value. How do you compute book value? Reserves and surplus is 250. Equity share capital is 250. Debt is 250. So obviously it is 1:2. Debt is 1. Equity is 2. So 67 and 33. Equity is 67. Debt is 33. So 67 into 14% and 33 into 5.6. Average you get 11.2%. This is the back. Have you computed the first part? Yes. Second part is what? Compute the EVA. EVA is what? EVA is your NOPAT minus capital charge. What is NOPAT? EBIT into 1 minus tax rate. What is EBIT? EBIT, they themselves have said sales is 1,000. Operating expenses including interest. So 620 includes interest. So you have to subtract the interest also because EBIT is before interest. So what is interest value? 8% debentures of 250. 8 into 250 comes to how much? Comes to 20 lakhs. So out of the 620, 20 lakhs is interest. So 600 is non-interest expenses. So 1,000 of sales minus non-interest expenses other than interest is 600. Basically, you have 400 as your EBIT. EBIT into 1 minus tax rate of 30%, you get 280, which is 400 into 70% is 280. This is NOPAT. Then you have invested capital. What is invested capital? It has to be taken book value. Please remember, as far as this EVA concept is concerned, you take book values for invested capital. What is invested capital? Your debt plus equity plus reserve and surplus, which is 750. So WACC of, what is the WACC? 11.2 into 750. You get 84. NOPAT minus capital charge. This is 280 minus 84, which is 196. You see, it's a straight flow. All numbers come one below the in line, in an order. Easy to understand. Correct? So if you remember this formula, it's very, very easy to understand. Next, what is market value added? Market value added is difference between market value of debt and equity minus book value of debt and equity. What is book value of debt and equity? We have invested capital is only book value of debt and equity, which is 750. What is market value? I think they've given 900. Correct. They've given market value as 900. So 900 minus 750, 150. 900 minus 750, 150. Assume 900 is market value of both in equity combined. If it is assume market value of 50, then MBA would be 900 minus 500. Here we have assumed market value of both debt and equity. If you just assume it is only for equity, then you have to assume that the market value of debt is the same as book value of debt. So debt gets cancelled, market value, book value. So this 900 minus 250 and 250, which is 500, which is 400 will be the MBA if you consider this 900 as market value of equity only. If you consider this for both for debt and equity, it is 150. What we got here. Right? Simple formula, format driven, one by one. Okay, we have completed this. Now let us go to the next question. Next question that I have, This is a question from November 24. This is what I was referring to. This here they've integrated a couple of concepts and given it in a good way. I actually like the question. There was some confusion by some students who felt that one of the numbers is not correct and all. We'll discuss that. EVA for ABC. Okay, EVA was 31 lakh 10,000. So, they have already given EVA. Now what? The following data relates to capital structure of the company at the end of the current financial year. Okay, equity, share capital plus reserve and surplus is 170 lakhs. Then debt 10% coupon is 80 lakhs. Invested capital is 250. 70 plus 80 is 250. Okay. Following data is given to estimate cost of equity capital, beta of ABC. Now 0.9. Now in this question, a lot of people assume that this beta is asset beta. Whereas on the face of it, when they've given beta of ABC, risk free, average premium and all of that, I believe it is not asset beta, it is equity beta. Okay, that is how I've solved the question. If you believe it is asset beta, please put that it is assuming that it is asset beta and solve the question, and any logical evaluator will give marks. Okay. On the face of it, it is not given. On the face of it, based on my understanding, because the rest of the data partakes, they have nowhere said, they have nowhere used asset, they have nowhere used the word lever and lever, they have nowhere used things like, along with capital structure, for the given capital structure, this is the beta. They have not said things like that. Or they have not said for a similar firm which is unlevered is the asset beta. So they have not made many mentions to give indication it is asset beta, which is why I am not assumed. But a lot of students assume, and I believe a logical, thoughtful evaluator and ICA in all its wisdom should give marks if somebody makes an assumption that it is asset beta. Now, you take risk-free rate 8%, risk premium is 10%, and beta is 0.9. So what is the WACC? There, straight on the face of it itself, you can compute, which is 0.9 into 10, which is 9, plus 8, which is risk-free rate, which is 8 plus 9 is 17. So 17% is WACC. More grade computation also required. Now, what have they asked? Calculate PAT. So they're saying EVA is given, work back at PAT. So EVA is 31.1. What is EVA? EVA definition is no PAT minus capital charge. What is no PAT? EBIT into 1 minus tax rate. We don't know what is EBIT. We'll come back. Capital charge. What is capital charge? WACC into invested capital. WACC we found out. I just told you WACC is 17%. What is invested capital? Invested capital is given here, which is 250. So 17% of 250. What is 17% of 250? No, we have found out here KE. I'm sorry, we have found here KE. So with this KE, you have to come back to WACC. What is WACC? Debt is 10% of 80 lakhs. But 10% is pre-tax or post-tax? It is pre-tax. What is the tax rate? 30%. So what is post-tax? Post-tax is 7%. 7% for 80 of debt and 17% for 170 of equity. What is the WACC? You do WACC, you will get 13.8. How did I get 13.8? You see. Same, your cost of equity is 7%. So 10 into 1 minus 30 for 80 and 17 into 170. Okay, you get 13.8. Okay, 13.8 is the WACC. For this WACC, into multiply this invested capital, you will get the capital charge. So what is the capital charge? 250 into 13.8 is 34.5. So EBIT into 1 minus tax rate, that is EBIT into no PAT minus 34.5 is 31.1. So using this, you arrive at no PAT. What is no PAT? No PAT is 65.6. No, profit after tax is 65. So what is before tax? Before tax is 65.6 by 0.7, you get 93.71. From this 93.71, this 93.71 is actually EBIT, but before tax. No PAT was EBIT after tax. So this is before tax, 93.7. From this 93.71, you have to subtract interest. What is interest? Interest, they've given the cost of interest as coupon as 10% on 80 lakhs. So which is 8 lakhs. So 96 minus 8, you'll get 85. From this 85, you have to subtract tax. Tax is 30%. So 30% of 85, you get 25, and then the PAT is 60. So round figure 60 is the PAT. So this is also one reason why I believe that the beta that they've given is, equity directly, the equity beta and not the asset beta. It need not be unlevered and all of that because you're getting a direct round number here. Okay, this is one. They have given one more question in November 24. This is also a very interesting question.
So friends, now let us look at the next question. This is also from November 24. AMN Limited has surplus cash of 200 lakhs and wants to distribute 30% of it to its shareholders through a share buyback. The finance officer of the company estimates that the share price after repurchase will be 50% above the buyback price. So this is a standard type of question in which you have to assume X to be the value of the buyback price, Y to be the number of shares that are bought back, and then make a simultaneous equation. It's very simple. Okay, it is not complex. I wanted to specifically solve this because these are the kind of questions that some students find it difficult, not everybody. But something where you just assume X and Y and you just move forward. It is super simple. I mean, I just love this question because you can get marks just like this. You solve it correctly, use the calculator, don't use your mind for mental calculations. Within 5 to 6 minutes, you'll actually get the answer. Okay, anyway, let's move forward. There are 15 lakh shares outstanding with a current EPS of 3, round off buyback price to 1 decimal. Determine the price at which shares can be repurchased. The market cap of the company should be 250 lakhs after buyback. Calculate the number of shares that can be repurchased. Assess the impact of share repurchase on EPS, assuming that the net income is going to remain the same. Right, now what is the surplus cash? 200 lakhs. Then how much do they want to distribute? 30%, which comes to how much? 30% of 200 is 60 lakhs. So buyback is 60 lakhs. Then buyback price, assume it as X. What are they saying? The finance officer of the company estimates the share price after purchase will be 15% above buyback. So if buyback price is X, post buyback price is 1.15X. Correct? Then current shares is 15 lakhs, current EPS is 3 rupees. So current PAT is 45 lakhs, multiply those two. Post buyback market price is 250 lakhs, that also is given. Now how many shares are brought back? They are asking us the number of shares that are repurchased. How many shares are brought back? Let us assume it is Y. You purchased Y number of shares. But for how much value did you buy back? You bought it back for 60 lakhs, which is the surplus money. So if that is the case, 60 lakhs is what you have, X is the price, Y is the shares, then obviously 60 by Y is equal to X or 60 by X equal to Y. That is what we have done here. That is, number of shares bought back is Y, and that Y is equal to 60 by the price at which it is bought back. Okay, and what is post buyback market price? Market cap actually. Post buyback market cap they have given us 250 lakhs. So you equate what? 250 lakhs is equal to post buyback share count. What is the share count? 15 lakhs minus Y, how many ever shares you bought back, into post buyback price, which is 1.15x. In this, you substitute the value of Y, what you have here, which is Y 60 by X. So you substitute it and then solve for it. What will you get? You will get the value as X is 18.5. What is X? X is the share buyback price. And they said 1 decimal. So 18.5 is round figure, no problem. How many shares are bought back? Which is Y. Y is 60 lakhs by 18.5. So you get 3,24,324. This is lakhs, please remember. What is, so far so good. What did they ask? They said calculate number of shares that can be repurchased. Already got 3,24,000. Assess the impact of share repurchase on EPS. So, and assuming net income is going to remain the same. So, if net income is going to remain the same, which is at how much? 45 or 60, which is at 45. 15 lakhs into 3 is 45. So, 45 lakhs is going to remain the same. But what is the new share count? New share count is this 15 lakhs minus 3,24,000, which is 11 lakh. So 45 lakhs by 11 lakhs, you get a EPS of 3.83. What was old EPS? Old EPS was 3. So what is the increase? 0.83. So what is the increase in percentage? 27.59. See, this is a super simple problem. This actually does not even require CA final level understanding of anything. It is simple mathematics. It is simple mathematics. Okay, very easy question. I genuinely, think these are the kind of questions that are sixer question. You hit it out of the park. Okay, next, coming to the last question that we will do for, in this revision module. This is an old question from May 2016 paper. I specifically want to do this question for a couple of reasons. I'll explain after we finish reading the question. Kanpur Shoe Limited is having sluggish sales during the last few years, resulting in drastic fall in market share and profit. The marketing consultant has drawn out a new strategy that will help be valid for next 4 years. If a new strategy is adopted, sales will grow at 20% per year over the previous year for the coming 2 years and 30% from the third year. So we are in year 0, 1 and 2 will grow at 20% and 3 and 4 it will grow at 30%. Other parameters like gross profit margin, asset turnover ratio, capital structure, income tax at 30% will remain unchanged. Depreciation would be 10% of fixed assets at the beginning of the year and targeted return of the company is 50%. Does this not look similar to a question we did earlier? Yes, it is similar, but there are certain other things. Let us see. The financials of the company for just concluded year is given as below. Turnover is given, gross margin, admin, PBT, tax, PAT. Okay, balance sheet, fixed asset, current asset, equity capital. You require to assess the incremental value that will accrue subsequent to the adoption of the new marketing strategy and advise the board accordingly. Present value factors for 1, 2 and 3 are so and so. Now, it will grow 30% from third year. Okay, after fourth year, what will happen? We don't know. We'll see. So, should we value this forever or should we value this for 4 years? So, in this kind of valuation questions, the fundamental question that arises is, are we doing it for eternity, that is, forever in life, or should we compute it only for the first 4 years? As of now, we have information for 4 years, but do we compute terminal value or we don't compute terminal value? See, when you are in the exam hall, this is the most critical question. Arey, karna kya hai? What should I do? Okay, if that is the case, if you are getting such kind of doubts, first start solving. Please, put up the data, start filling up things. As you move forward, you will realize that this is what they want. Okay, what is it in this case? We'll see. So, first year 2 lakhs turnover, then grows by 20%, 20%, then 30%, 30%. Okay, then gross margin straight 20%, 20%, 20%. Admin expenses they said is 10%, and they also said what? Asset turnover, capital structure, income tax will be remain unchanged, depreciation will be 10% of net fixed asset. Why does this admin expense include depreciation? Because they have not given separate depreciation line, and they have just said gross margin in PBT. So, admin expenses includes depreciation. Why is that important? Because depreciation has to be, there is an adjustment between depreciation and capex. We've done this in earlier problem, we'll see. So, including depreciation, this is the administration expenses, which is 10% of sale. Gross margin also 20% of sale. So, PBT you got a value. Then you subtract PAT at 30%, you got PAT value. Now, at this point, this PAT value, what am I supposed to do? Am I supposed to project or not? We will see. Balance sheet. Fixed asset is 80,000, that's what they gave, right? Fixed asset 80,000, current asset 40,000, and equity is 1,20,000. So, fixed asset 80,000, and what is original fixed asset turnover ratio? 2 lakh by 80,000, which is 2.5. So, that 2.5 ratio will remain the same. So, for every year, turnover divided by 2.5 is equal to fixed asset. Turnover divided by your 2.5, which is the turnover ratio, fixed asset turnover ratio will be your fixed asset value. What is current asset? Current asset is 40,000. It is 20% of your revenue of 2 lakhs. So, every year it is 20%, 20%, 20%, you projected the current asset. Then you added total asset, which is equal to total equity. Now, they have asked us to compute the value of the new strategy. So, you compute something called FCFF. Here in this case, FCFF, FCFE, both of them are same because there is no debt. PAT, you write down the figures, whatever you have. Then change in working capital. What is change in working capital? You subtract the increase in current asset. So, this 8,000, then another 9,600, so on and so forth, you subtract. Then you subtract capex. How did you get capex? Capex number is, please remember, they said here something about depreciation. If you directly go and take the change in the net fixed asset, what is this? This 80,000 to 96, 96 to 115, 115 to 149, gone. You lose marks. You have to first put up a schedule. What is the schedule? 80,000 first year is opening. How did we get 80,000 opening? Because they gave that in year 0, closing is 80. So, that is the opening. And fixed depreciation is 10% of NFA. So, minus 8,000. So, and your closing is 96,000. Where did I get closing? This closing you got it from here. So, that you bring it down and find out the balancing figure as capex. 80 minus 8 is 72, closing is 96, 72 has increased to 96 because there is 24 of new capex. Like that, every year you find out the capex. This capex you subtract. Then you add back the depreciation. You subtract the capex, add back the depreciation, you get FCFF. You got FCFF for 4 years. Right. Right. Now, please note, everywhere it is negative. Why is it negative? Your PAT is positive, but there is an increase in working capital which is negative, there is a capex which is negative, both of them are making your FCF or FCFF negative. Okay. So, what do you do? This is where the point that I was trying to tell you comes into play. What is the point I was trying to tell you? I was trying to tell you, if you don't know whether you have to compute terminal value valuation or not, because you see, if you remember, there was one question where they said that, next 4 years of profit. There it was very clear that only next 4 years profit. But most often than not, you have to compute terminal value everywhere. In this question, it is all the more reason why you should compute, because you have a end of the period negative FCF. So, where will the value of the business come from? It primarily comes from your terminal value. Okay, let us see. FCF of first year, second year and third year. Okay, and fourth year is 33,332. And please also note one more reason why you should compute terminal value. They have given only 3 years ka present value factors. Why did not give 4th year present value factor? Because you will use 4th year cash flow to arrive at a terminal value at the end of 3rd year. That is P0 is equal to D1 by KE minus 3, right? So P3 is equal to D4 by KE minus 3, something like that. So here you take last year's number divided by KE minus G. Growth is 0. So cost of equity is 15%. They themselves have given cost of equity, present value factor at 15%. So you take that and arrive at a terminal value. So in this case, terminal year cash flow is negative. So the present value of all future terminal cash flows or till eternity is also going to be negative. So you take all these negative numbers and add up. You get 2,47,779. And then of course, first 2 years also you multiply that with the present value factor, you arrive at something. So you arrive at 1,75,833 as a negative value of this new proposal. The value of business with new strategies minus 1 lakh. The value of business without new strategy. Since in year 0, it will be 14,000 as there are no changes. So what is year 0's FCF? Year 0's FCF, we can compute it here only, PAT. Okay. And depreciation. Now, CapEx and depreciation, we can assume they offset each other. Working capital, we will not grow because the business is not going to grow. So you can actually assume that this 14,000 is your first year's FCF. That 14,000 divided by 0.15, you get 93,000. So this 93,000, whatever is positive, is becoming negative of minus 175. There is an impact of minus 269, right? So incremental value of the new strategy is negative. The company should not go for new strategy as it is negative. So these are the points. So see, ICAA may sometimes give a googly kind of question where everything appears negative. Okay. It is very much possible. It gave it in which period? May 16. So please don't think that answer always has to be positive. Answer always has to be a round number. Okay, logically most of the times yes, but there are times when ICAA throws these googlies. So I wanted to show you these things when you are given data, when it is not known what you are supposed to do, whether you should compute terminal, not compute terminal, it is coming negative, am I right, am I wrong? Please apply, think logically and make assumptions and move forward. That is the only way in which you can complete the paper, solve this question and get the marks that you desire. Okay, now we have finished all the practice questions. The next part is to finish the rest of the theory aspects. What are the rest of the theory aspects? We have completed how to value a distressed company, right? That part we have finished. Now what is left is how to do startup valuation. Startup valuation, then you have methodology of startup valuation, digital platforms, then how to value digital platforms, then ESG. These are the aspects which are theoretical, and believe me friends, from these is where I expect 1 or 2 questions in May or November 25. The reason why I am saying so specifically is this is a completely new topic. Okay, these new topics carry more weightage. Institute has introduced them so that they can test. They believe these are important, these are new, these are more modern. You need to be aware of these. That is why they have added. So if you don't prepare for these and go to the exam, there is no value. You'll be looking here and there, scratching your head when the question comes in exam. So please don't do that. Please study these aspects carefully. Don't think that business valuation chapter, or for that matter any chapter, is just purely a practical paper. It is a theoretical paper also. I know that in November 25 they asked hardly 4 to 8 marks of theory questions. That is fine. But if you get a 4-mark question, for what? It takes you hardly 5 minutes to study, boss. You'll see, this is, once you have studied it for a couple of hours, then 5 minutes revision. That is what I mean, okay. When we are now going to revise it, or when I'm going to explain to you, it will probably take half an hour. That's all, 20 minutes to half an hour. You'll be able to understand it, and you glance it once a day for 2-3 minutes, you'll remember it. It is as simple as that. Okay, now let us come back. We are going to look at startups as a separate chapter, okay. But startup valuation is part of this business valuation chapter. So what are startups? They don't have any established business. They have little historical information. Their value is based on everything is on future. They are untested ideas. They expect consumer to behave in a way. It is purely driven by founders' competence, self-belief and drive. Okay, it is not dependent on some historical cash flows. And founders walk in dark and convince investors of their night vision. This is one very good statement actually in the CA material I read this. There is, even the founders walk in the dark. So basically founders also don't know everything. They are walking in the dark and they are saying, I can see the future, I can see something is there, I have night goggles, and then they are leading the investors. It is like that. And it is not that they are cheating, it is that they are trying to build a new business for which there is no parallel. right? So such kind of things, please do not assume that somebody is being unethical or cheating or something. They're trying something completely new, completely that will change the way the market looks at it, right? This is what is a startup. Now, what are startup value drivers? Product, unique products, and where there's a prototype already created, you will get higher value. Management, founding team, academic background, credentials, well-rounded team, they drive valuation. Traction, higher the traction, higher the value. So if faster you are growing, faster the value. More revenue streams, greater value. If you are monetizing faster, you get greater value. Attractive industry and scalable business, but you can scale it fast, it can become big, it can become 1 billion, it can become 10 billion, it addresses half the country, then it has greater value. Less competition, greater value. So these two, if it is an attractive business, why will there be less competition? There will always be other players. Okay, so these two are slightly opposite to each other, but then still they both matter. You don't need too many competitors, you need fewer competitors, but you need an attractive business. Okay, now how do you value startups? You value startups, again, same logic, earnings based, asset based, market based. Okay, the reason why these may not correctly or accurately reflect valuation of a startup, we will discuss. The cash flows or earnings based, negative cash flow behavior normalized. Every startup, you take Zomato, Swiggy, Paytm, all of them have negative cash flows. When will they become positive? After 5 years. Nobody knows. So we have normalized everything. So then how will you discount the cash flows? How will you discount earnings? Earnings itself are negative. Then difficult to value startups with no cash flows or earnings. That is the reality. Then asset based. Which startup has tangible assets, you tell me? Most of them operate out of corporate office with thousands of employees. Employees are their only asset. They have intangibles like brand, intellectual property, code, and all of that. Startups are negligible tangible assets. Valuing intangible is tough for a business that is yet to be established. Despite an established business model, startups operate under going concern assumption, incorrect to value at realizable value. Even though their business model may or may not be fully established, a startup still believes that it is going to sustain, make it big. So it is still a going concern. If it is a going concern, how will you value it on realizable value basis? You can't. Right. So that is what they are saying. Asset approach also does not work. Then market approach. Market approach, generally very few or no established competitors. We just now discussed, you want industry to be attractive, but fewer players. If there is nobody, so first time when Zomato listed, how was it valued? People took benchmark of a company called DoorDash in US. First time when Swiggy was listed, how was it valued? People took benchmark of Zomato, right? But for Zomato, it was DoorDash. For DoorDash, what was it? Nothing, right? So very difficult to get benchmarks. Competition may be in form of other startups. Yes, for Swiggy, Zomato is a competition. Metrics of other startups may be skewed too. So Swiggy also negative cash flows, Zomato also negative cash flows. Who is big? How will you compare both of them? How will you compare them based on EPS, and both of them are negative? However, market approach is a lot better to value startups. Despite all of this, you can compare Swiggy and Zomato. You can say Swiggy delivers so many orders per day, Zomato delivers so many orders per day. Swiggy has raised this much money, Zomato has raised this much money. Swiggy has this much turnover, Zomato has this much turnover. So like that, you can compare them on certain metrics which are comparable. That is why a market-based valuation is more preferred in startups. Now, we will look at other methods of startup valuation, which are recommended by a bunch of people, and they're replicated in our material. One is called Burkus approach. There are 6: cost to duplicate, comparable, scorecard, first Chicago. First Chicago is very simple. You have 3 DCF scenarios, expected 3 scenarios. You take weights of it: best, worst, and best case, worst case, base case. That is very simple. They give the weights, they give the the 3 methodologies. You take average of that. That is first Chicago. What is this first thing called Burkus approach? In a Burkus approach, you consider 5 factors. What are these 5 factors? Basic value of the business, technology, execution, strategic relationships, production, and sales. What you do is, these are the only 5 factors. Okay, we will come to a scorecard based valuation where it is you consider some other factors, but here you are considering only 5 factors, and you assign weights based on criticality. So each component for this particular business, how critical is it? For this startup, how critical is this? And assign weights. Based on those weights assigned, you say, now for this business, this is the weight. How good is the company as of now? So let's say there is one business, we are valuing one company called X. For this X, strategic relationships have 50% weight. Okay, now how good is, I am valuing the business first. I am saying ideal, this is ideal. But what have our founders done? Have the founders placed enough importance on this? Have the founders done enough for this? No, probably yes. Okay, so 50% value. So I will assign full weight to this, saying that these guys have done the work. Okay, if they have not done the work, I'll probably reduce it, increase it, do something, and then arrive at a value. For pre-revenue, I will cap the value at 2 million. For a post-revenue, I'll cap the value at 2.5 million. So these were very early stages. So I will assign certain I will pick out these 5 factors, assign weights for each of these factors on ideal basis for this business. Then I will check my current, this particular startup, how much weight should I assign, and then I will arrive at some kind of weight. For an ideal business, I should give 2 million, but this business, because there are some factors they are weak, I will not give 2 million, I will give only, let's say, 1.5 million. So you do something like that. Okay, that is how you do the Burkus approach. Now let us go to the cost to duplicate approach. What is this cost to duplicate? It considers all costs, expenses associated with product development and physical assets to determine the startup's fair value. So this is a very weird approach. Nobody typically follows this because startups are not about what is the cost to duplicate. Okay, if you want to cost to duplicate, how long will it code, how many coders are required, each code what is salary, how long will they take, and how much code is to be written, how many lines of code is to be written. So now based on this, it will cost me 1 million, so the startup value is 1 million. This is not at all a fair thing because it does not consider the future value potential, it does not consider the market size, it does not consider anything. It thinks of a startup as lines of code or human resources. That is not at all a correct way. It does not focus on future revenue projection. So that is not the right way. Comparable transactions. What is this comparable transaction? Uses metrics of comparable startups. That is user downloads, easy to use, multiples of to be adjusted proprietary technology, industry penetration, local advantage. Comparable startup. This exactly is like that Zomato, Swiggy. Swiggy serves 10 million people a day. Zomato serves 5 million people a day. So Zomato should be valued half of Swiggy, something like that. So Meta, Facebook Meta, they have daily average users of 1 billion. Snap has only 500 million. So Snap should be valued half of Meta. Things like that. Or Snap has per user, Meta has lifetime value of $10. Snap has $5. So $5 into 500 million. So that is how I will value it. Right. So like that you value startups. Easy to use, multiples to be used, adjusted for proprietary technology, intangibles, so on and so forth. So you will take a multiple but adjust it slightly up or down. Then scorecard based valuation. What is this? Used for pre-revenue businesses. What do? Find the average pre-money valuation of comparable companies. So you take comparable companies, find the average pre-money value of these companies. That is all of them, what is the value. Then some product of all factors versus current startup metrics of following measures. Value. What is the value? Value is some product of all factors of current versus comparable startup. That is team strength 0 to 30, opportunity size 0 to 25, product 0 to 15, competition 0 to 10, sales is so much, investment is so much, others is so much, investment required is so much. So this is very similar to Burkus approach, but Burkus approach you take these 5 only. Here you are, and even in Burkus approach the weights are not predetermined. Here they are giving a range for weights and they are saying use similar weights, compare with other startups and then assign. Right. So factors are also different, weights are also different, and you are comparing with a bunch of other startups and then you value your startup. So that startup is already valued, you value your startup basis that. And first Chicago method is what? Expected DCF, very simple average, weighted average of those. Then you have something called as VC method. What is this VC method? It is return on multiple of initial investment, 10x, 20x, 30x of initial investment. Return multiple is based on expected IRR. So what happens is your VCs, they invest some X percentage. They usually think of it as I invest 1 million, I get 5%. I invest 10 million, I get 20%. They always think where will this particular startup end up towards the after 7 years or 10 years. Let's say I'm investing, I get 5% stake, I invest 1 million. After 7 years, let us say this startup size will be 1 billion. I need 5% stake in that. 1 billion, 5% is 50 million. So this 50 million is what I will get. So I have to get, and this is going to be 10 years. 10 years is what is the life of this thing. So in 10 years, I need to generate 15% IRR, which means I need to get a 10x multiple, which means I will get, I need to have a stake. Okay. I can put up to 5 million because I will invest 5, I will get 50, which is 10 times, which on average works out to 15-16% IRR for me. So I will take up so much stake so that I can get up to 5 million, and eventually after all dilutions, my stake after 10 years is 5%. So initially my stake may be 50, but slowly it will dilute, and finally my stake will only be 5%, but that 5% will be valued at 50 million. Initially I put in 5 million, that 5 million became 50 million, but my stake initially was 50%, now has become 5%, right? So from that way you look at it and say, I need this multiple. So what they do, return on multiple of initial investment, 10x, 20x, 30x. So this is the return that I require. That is how they look at it. They look at it as, I want this return at the end of the period. This is what I will put in now so that I get that return. Okay, very weird and convoluted way, but that's one way. And I've actually seen people do invest like this. I've physically seen the investment happening like this. Okay, next, what are we saying? Valuation of a startup is much more than application of methods. It is about understanding the story of the future trajectory and communicating the narrative using substantial numbers. So please don't think startup is just some Excel sheet. It is not some Excel sheet, some product. It is, you have to understand the story. You have to, because they do not have cash flows initial days, there is a lot of focus on understanding story and using some methodology like this Burkus method or scorecard method. Otherwise, once the numbers start becoming big, it becomes comparable transactions only, largely comparable. You look at Swiggy, Zomato, that is what happened. You look at any other startup which is, Meta when it came, that is what happened. Snap, same thing. Google when it came, similar stuff. So, people who came after Google took Google as benchmark, right? So, this is what you need to remember. Then you have something called as digital platforms. What are these digital platforms? See, there are 6 varieties of digital platforms. One is called as a marketplace, where you have multiple buyers matched with multiple sellers. Example, booking.com, amazon.com. So, a digital platform is software-based online infrastructure that facilitates interactions and transactions between users. Very generic definition. Marketplace is one. Then you have search engines. People looking for information are matched to multiple sources of information. Google, Bing, Baidu. Right. Repository means they store stuff. What, like suppliers deposit their materials into a type of library, like your GitHub, YouTube, we all store videos and those videos pop up, right? Then digital communication, users send messages and documents to each other, example WhatsApp and Teams. Then you have digital community, your virtual connections with other people, Facebook, Snap. Then you have payments platforms, senders send money to receivers, Google Pay, Paytm, etc. So these are the kind of digital platforms that exist. Why are we discussing about that? Because their valuation is also very important. How do you value digital platform? Income approach, market approach, cost approach. It's very similar stuff. In income approach also, you have top down and bottom up. In top down approach, what happens? You estimate the total addressable market. What is total addressable market? What is the market that you can potentially sell to? Let's say you are manufacturing clothes. Entire India is your target audience. But are you manufacturing formals, non-formals? Are you manufacturing men, women? What is the age group? Age group is 0 to 1, 1 to 10, 10 to 20, more than 20. What is it that you're doing? That becomes estimatable, serviceable market or obtainable market. So clothes is an overall market, but I am producing, menswear only, specifically shirts for people who are above age of 20. That is serviceable, addressable, obtainable market, SOM or SAM. In that market, how much market share will I get? How much revenues will I make? That is one way to look at a platform. Okay, I've given you example of shirts. Okay, when you talk of a platform, it is not the platform is none of these, right? Think of it as marketplace. Okay, think of it as Amazon. What are total internet people buying on internet in India? How much of that? See, what are total buying in retail? That is the total market. What is serviceable market? People who are buying on internet using certain things, how much can they buy? That is the serviceable or obtainable market for Amazon, right? Then platforms have high cash burn due to penetrative strategies. Very difficult to estimate market size and market share. This is absolutely true, because if you look at Flipkart or Amazon, Flipkart and Amazon, both of them are in losses only, right? Most of these guys, if you look, Paytm is in losses. Then you have Amazon, for a very long time it was in losses, then it became profitable, so on, right? So you have a variety of reasons why people may or may not be in earning profits. What is bottom-up approach? It focuses on projecting financials based on current financial position and scaling efficiently. So it doesn't talk, when you look at a bottom-up approach, it says today I am selling to 100 people, tomorrow I will sell to 120, day after tomorrow 150, slowly I will grow like that. When I grow like that, what is going to be my revenue? What is going to be my P&L? What is going to be my cash flow? Like that I will value. Okay. Now, both top down and bottom up, both are used, both are relevant when you evaluate digital platforms. Now, let us look at other things. Considerations used in valuing bottom up or top down. What are the considerations? You use FCF and WAC or FCFE and KE. So, when you are valuing any platform, for that any matter any business, when you have FCFF, that is cash flow to the firm, you use the discounting rate of WAC. It is cash flow to equity, FCFE, you use the KE. Okay, estimating in beta for startups is a challenge. Absolutely. Beta estimation for startups is a nightmare. Then survival of platform dependent on management quality. How will you know whether organizational survival or nothing? It is purely management quality. Then company specific risk premium needs to be added to CAPM to arrive at KE. So what people do is for beta, they take comparable beta or they take listed companies beta, they make adjustments to that beta, same way they take some risk premium, they add that risk premium. So for CSRP, that is company specific risk premium, they add it to the normal discounting rate to inflate it so that it is not valued the way you value HUL, you cannot value some small startup which is doing FMCG business. It doesn't work that way, right? So you add a premium. Now, this is tops down, bottom up. What is market approach? You use ratios like PE, EV by EBITDA, price to book, price to sales. But most of them don't have earnings, most of them don't have book value because most of their assets are intangible, most of them may or may not have EBITDA. So what do you use? You largely use price to sales. Choosing right metric is important. Fewer listed platforms, earnings are minimal, platforms are usually capital light. Hence focus is on revenue based driver. What are revenue based drivers? Price to sales. Okay, or EV to sales. You do things like this. This is how you value platforms. Then you have cost approach. What happens in cost approach? Estimates value based on total cost incurred to build the platform. This is what I discussed. What is the in the same way what we value startups? No, you digital platforms, you value everything using how much cost. Then estimate hours required to write the code, ignores the revenue generating capacity. Same issues what I told earlier apply here. Conclusion: value of platform depends on business understanding. You have to understand the business. First thing. Then revenue model, management quality and risk reward ratio. What is risk reward ratio? That is, how risky is this? If given this risk, how many times return am I going to get? Will this business generate so much return? Okay, that is what we are referring to here, risk reward ratio. Now, then what are the drivers of revenue here? Marketplace, number of bookings made, number of registered users, volume of transactions. Payments, number of subscribers, merchants, then community, number of users, subscription fees. Communication means what? Here we've discussed, no? Communication, digital communication, WhatsApp and Teams. Communication, number of users, sponsored links, ad revenue. Repository, number of readers. Search, number of users. So these are the metrics, drivers of revenue. You either use price to sales, EV by sales, or you use the methodology what I was telling you. Google has this many, 1 billion users. Snap has 500 million users. So you value Snap as half of Google. You use either these broader metrics at a higher level if you have a listed comparable. If you don't have a listed comparable, you go for, even if you have a listed comparable also, you cross check this with these kind of metrics. Whether it can be user based, it can be transaction based, it can be anything, right? Now, after having understood these three, we'll come to something called valuing professional consultancy firms. So things like CA firms or advocates or people like that. Compare historical and current KPIs with industry benchmarks. What is this KPI? So number of statutory audit clients, number of internal audit clients, which are more remunerative, statutory audit or internal audit. What is your margin on a statutory audit, margin on internal audit? What is the staff ratio? How many are high level, mid level, low level? Like that, you arrive at a variety of ratios, or rather a variety of key performance indicators for your startup, and then compare it for your professional consultancy. Professional or consultancy business, and compare them with other similar businesses. You compare auditor financials and IT returns, obviously. Okay. Under income approach, here also you have income approach. Terminal value determination is tricky due to inherent risk of future earning not materializing. So just like any other business, even for professional and consultancy firms, very difficult to take terminal value. Okay, because nobody knows which way it turns out. Normalization of net income and cash flows is important to improve comparability and example add back non-cash items. So some kind of firms, the partners may get different kind of remuneration. They may be getting more than market. Other firms, they may be getting less. You can't compare both. You have to normalize for both of them. Alright, different industries have different KPIs. Obviously, a CA firm will have different KPIs, advocates will have different KPIs, doctors will have different KPIs, your consulting firms have different KPIs, large consultings will have different KPIs, small consulting have different KPIs. So different people, different KPIs. You have to take that. Look at KPIs that are important for acquire and all KPIs. So from a transaction perspective, don't bother about what every KPI of the target. Bother only about the KPI that is relevant for the acquirer and compare and based on it take a decision. Okay. So, this is one more point of how to value professional or consultancy firms. Now, finally, we come to something called as ESG, Environmental Social Governance Framework. It is a very, very important thing. This is the latest thing everywhere. SEBI has also introduced guidelines for this. Most of the annual reports contain something or the other. Most of the finance, you also have a social finance which is related to this. What is this? It is a framework designed to be embedded into an organization strategy that considers the needs and ways in which to generate value for all stakeholders such as employees, customers, suppliers, financiers, everybody. So, you are generating value for everybody, not just for shareholders. Now, what are the illustrative list of social ESG factors for climate change? So, you bother about climate change for environment, water, waste generation, emission, biodiversity. So, you look at your business from all these aspects. You consider all these aspects also and then take a decision as to give out commentary saying that we conserve water, we have little emissions, we have green cover, we have climate change, we take care, all of those. Same way social. We focus on employee development, diversity and inclusion, community and development, health and safety, customers. So, we focus on all aspects as far as social is concerned. Then governance, we have a great board, very independent, diverse board, anti-corruption, tax transparency, ethical conduct. What do you do with all of these? All of these you are trying to convey in your annual reports or to your investors or in fact to everybody, in stakeholders, investors, government, society at large, that you are a conscious organization. You care about the environment, you care about the society, you care about the governance, not just profits. And how will this help? Because I am a conscious person, you should value me better. You should highlight, if I will highlight the things that I am doing, and if I am doing something bad, I will correct. Because of that, I should be valued better. Why? Because I am doing something for environment, society, and all the stakeholders in general. Right. So, what happens in this ESG space? What are the key developments? You have significant focus on green bonds. So, a lot of companies which are focused on green business issue bonds called green bonds. These bonds are issued at a much lower rate than normal bond. Okay, so it reduces your cost of borrowing. Then sustainable taxonomy on the rise. So, taxonomy means language. So, everybody uses the word sustainability at a lot of places. See, some of them you can think of it as jargon. Randomly they are throwing words here and there. No, but a lot of places they use sustainability. Everyone in the organization focus on sustainability. So, people don't do things which are bad. So, let us dump all dangerous waste into the ground. No, people will not do. People say, we are a sustainable organization. How can we do this? Right. Convergence of reporting framework with IFRS. So, IFRS also has standards related to this. SEBI is focusing on disclosures on this. I've already told you that. And investment pace in ESG funds has picked up. So, a lot of investment. So, there are ESG focused funds which invest in good quality companies. They don't invest in companies which fall foul of these three aspects. Right. So, what are the other key developments? Companies with high focus get benefits in the form of preferential lower cost of debt, access to specialized financial products like green, sustainable, social linked bonds. That is what I was telling you. It has become a must have from good to have. So, everybody needs to have this at any cost. It is not good to have, it is must have. Then business case begins with operational efficiency and risk reduction and extends to long-term operational organizational resiliency and sustainability. So, initially it is focused on efficiency. Slowly, we have to live, this is the planet, we have to take care, these are our people, we have to take care. So, organization has to be sustainable, organization should live long. So, it is actually focusing on the entire ecosystem rather than immediate returns to the shareholders. Impact of ESG risk can be incorporated either in discount rate or expected cash flows to include ESG risk in company valuation. Generally, people increase discount rate, but adjusting cash flows is more explicit and appropriate. So, you can adjust if the company facing ESG risks. So, either you can increase discount rate or reduce cash flows. Typically, it's easy to increase discount rate, but actually the right way to do it is adjust cash flows. How do you adjust cash flows? You say environmental risk, social risk, governance risk, all three you will incorporate in cash flows. How? Environmental risk can be incorporated by carrying out 2-degree scenario analysis. That is, if temperature of the planet is increased by 2 degrees, what is the cash flow? What will be the change to cash flow? Similarly, adjustment in cash flows can be made by considering carbon points. So, if there is a 2-degree increase in environment in the temperature, what will happen to your business? That is what you are evaluating. Social risk can be considered adjusting the impact of social measures, cost on the revenue such as better labor conditions, CSR and other welfare measures for various stakeholders. That is, you consider all this. I will improve better working conditions, I will have CSR. So, all of this will have impact on my cash flows. What will happen? Then governance can be considered by adjusting impact of poor governance on revenue in form of penalty, taxes, so on and so forth. So if I have good governance, my penalties will come down, my tax rates, my tax issues will come down, all of that. So that will have immediately probably cash flows may be impacted, but slowly my cash flows will increase. So that is how you evaluate or incorporate all the ESG risks in cash flows. This is the ideal way, even though discount rate adjustment is the easiest way. Okay, so this is the entire summary of this particular chapter called business valuation. Okay, very important, very interesting chapter. You typically get at least one question from this chapter every attempt. If they miss in an attempt, in next attempt they will ensure that they will give. So please be very careful. It's a very easy chapter, some amount of theory, but a large amount of practical stuff. You have to understand basic things of FCFE, FCFF, various methods of valuation, your earnings by, what is PE, what is EV by EBITDA, what are various methods. Specifically focus on startup valuation, ESG and digital platform valuation, because, and of course this professional consultancy firm valuation, because these are new topics. Of course, even that going concern valuation, distressed company valuation, all those are also very important because they're also new topics. Believe me, it's a very easy chapter. So if you've gone through my entire revision session or a fast track class for this chapter, there are other revision sessions and fast track classes for other chapters also. Please do check them out, where I'm covering each chapter in great depth, but in a very, very short span of time. Okay, so I wish you all the very best for your exams. Do like, share, subscribe to this video. Please refer us to your friends. Please share this video to your friends, please, so that everybody can get help. And please note, this particular deck is also available as part of the class videos. Okay, all the very best.